Garcia Richard.
I'm here.
Treasurer Laura Montoya.
Good morning.
CFA Secretary Wayne Probst.
Present.
Nick Tejas. Nick Tejas. No, it's Catherine Allen.
Here.
John Bingaman. Here. Tim Jennings. Harold Lavender.
Here.
Mike Messina. Kurt Sommer. 1, 2, 3. We have 6 that answered in the affirmative, so we do have a quorum.
Move on to approval of today's agenda.
Move approval. Second.
Any further discussion on that motion? Do we have a roll call vote on that motion?
Treasurer Laura Montoya.
Yes.
Secretary Wayne Probst.
Yes.
Member Nick Tejas. Catherine Allen.
Yes.
John Bingaman.
Yes.
Harold Lavender.
Yes.
And I'm sorry, Commissioner, did I call on you? Commissioner Stephanie Garcia Richard.
Yes.
Okay. 1, 2, 3, 4. That's 6 in the affirmative. We have motion passes.
Madam Chair, Nick's online. I'm guessing he was probably muted because his red little thing was up, so I'm sure he's here.
Yeah, it's
Connected right now.
okay. We'll watch.
All right, let's have a motion for approval of both the September and October minutes.
So move.
Second.
Are we able to do C and D in one vote?
If you prefer split up, you can, but you're fine as is.
Any objection to doing C and D in one fell swoop? Okay, so we have a motion for approval of the September and October minutes. Any discussion on the motion? Okay, let's take a roll call vote on the motion to approve both the September and October minutes.
Commissioner Stephanie Garcia Richard.
Thank you, yes.
Treasurer Laura Montoya.
Yes.
Secretary Wayne Probst. Okay. Oh.
Yes on everything.
Nick Tejas. Catherine Allen.
Yes.
John Bingaman.
Yes.
Harold Lavender.
Yes.
1, 2, 3, 4. Motion passes.
Let's turn it over to our interim state investment officer for this briefing, agenda item 2A.
Thank you, Madam Chair. Run through this as Steve once did. As of yesterday, we had $46 billion, $46.23 billion assets under management. Distributions for the fiscal year to date from the land grant, severance tax, and early childhood funds are $592 million in the first 4 months of the fiscal year. The full year beneficiaries, general fund, and schools will receive nearly $1.8 billion. That's a record number, and that is up almost $500 million year over year. The inflows, however, we should note they continue to exceed that amount as expected during the short and mid-term. Inflow from the state land office last month was $193 million, for a little bit of context. In operations, we are still trying to source various positions, everything from analysts to the director of public equity to, of course, the state investment officer. At this point, I would like Member Allen, the head of our governance committee, to give an update on that search for state investment officer, please.
Madam Chair.
Yes, thank you, Madam Chair. We
I'll make sure I'm on, we have a meeting on November the 1st and 2nd for the first round of interviews for the candidates that we have. It will be in the Summers law firm, law offices. It'll be the 3 committee people, in addition, 3 other council members, Treasurer Montoya, John Bingaman, and Nick Tellis. We will have questions ahead of time and the information on the candidates. And we're hoping to come out of those meetings with 2 to 3 candidates we will then bring before the full council to have a chance to meet and talk to. The session will be a closed session, and that will be the only discussion during that time period will be about the search for the state investment officer. That's my report.
Can you take questions if there are questions from council? I'm sorry, I'm self-listening. You are finalizing questions, or questions will be finalized today?
They'll be finalized and will be out before we have those meetings in the next, I think towards the end of this week, we should have the questions. And we'll share that with the full council. And again, all of you had access to the secure portal to see the resumes of the candidates.
May I ask a question, Madam Chair?
Madam
Sure.
Chair.
Madam Chair, are the people who are not part of the top 6 or 7, were they contacted this week?
Yes.
Thank you so much.
Other questions?
Shifting gears a little bit, so the SIC will have an initial budget hearing in front of the Legislative Finance Committee tomorrow. We are seeking a budget of $73.7 million for fiscal year 25. That is an increase of about $6 million year over year. Almost all of that, $5.75 million of it, is due to contractual services and investment management fees that have grown due to the growth of assets under management. Expansion of our total authorized full-time employees, total staff is our primary goal. We're currently recruiting for 7 positions, and we'll seek 6 additional positions this year. This may have some more detail on that in his report. Of course, a reminder, any budget that's granted but unused does revert to the source, meaning the land grant or severance tax fund. In external relations, we have been meeting with some clients this month. Generally, what we hear is they're pleased with the investment performance, but they are asking for more frequent updates and more data behind it. Vince and I have agreed that we need to put some more resources to work at the SIC on this internally. So he's asked Don Iglesias to join me in working with RBK and making some incremental improvements to what we do for those clients and the $2 billion that we manage for them. Lastly, we will not be meeting this month with a group of county managers to discuss potential client services, as we had indicated we were going to last month. So we did some additional research, and we no longer have certainty that SIC can provide these services to the smaller non-A-rated counties. While the SIC statute is very clear that we have the ability to do this, there is another section of law, 61010, which is the Treasurer's statute, and it refers back to the SIC statute. But it states that only A-rated counties are allowed to invest with the SIC. And it's silent on the smaller counties that are not A-rated. So we have a bit of a conflict in the statutes. Our statute's very clear. It says, regardless of any other statute, we have the right to do this for any political subdivision in the state. However, the Treasurer's statute was updated in 2019. The SIC statute wasn't updated, was last updated in 2015. So we are reading into that this conflict exists, and so for the time being, until we can clarify this, and we're glad to work with the Treasurer's office, any other stakeholders on this matter, we think it's best to not take on that money. I would point out we do have a Class H counties that we've done investing for more than 20 years. Los Alamos County, they don't fit the letter of the statute either, other than the SIC powers that exist. Madam Chair, that's my report.
Madam Chair, Charlie, what's the definition of an A? Just out of curiosity, is it size or is it money?
It is size. It's based on size and population, and along with that, we are also allowed to invest for municipalities that have 65,000 people residing there or more. We don't have any other conflicts of this nature. So it's the smaller counties that are kind of left out of the mix. They don't have access to these types of strategies. They have to put their money with the treasurer, and that's all that's really allowed explicitly by law.
Madam Chair,
Madam Treasurer.
point of clarification, Class A counties, there's 5 of them within the state of New Mexico, and it's based off of valuation and population. So how much money they actually bring in for value. This is the first I'm hearing about it, but I'd be happy to work with you guys and discuss the reasoning that county treasurers put that in place. Most smaller counties don't have the capacity to invest longer term and don't have large portfolios or investment advisors that can assist them. Class A counties usually have a lot more money and they have investment advisors, and if they don't, they do buying and selling directly and can diversify the portfolio in doing so. With SIC, it's higher risk and it's usually more longer term, which most smaller counties don't have the availability of funds to be able to do that. So that was where the historical aspects of why the county treasurers all unanimously supported the idea of only Class A counties being able to invest with not just that, but commercial paper A1, P1, and supranationals, which is what we added in the year that was referenced. Thank you.
Anything further? Now move to agenda item 2.
Thanks, Madam Chair. So first, let me comment on the inflows. They are continuing to come in, as Charlie mentioned, just very high, very strong. That really has 2 advantages for us. The most obvious one, of course, is more money for the state. But the second advantage, and maybe even larger, is that these inflows are exceeding our distribution. What that means is that the investment earnings of the portfolio stay in the fund and compound to better rates of return for us. So historically, the inflows have been about 2/3 of our distribution. We've had to make up the other third through distributing investment earnings. But now with the inflows above the distribution, all of those earnings are staying in the portfolio and continue to compound at our current investment rates of return. So just a wonderful situation for the state. I just wanted to remind you all of that. Out in the economy and markets, there's just so much going on. At our last meeting, September 19th, I briefed you that the preponderance of the risks or the change in the risks in the world were geopolitical as opposed to financial. Still, the financial risks we've been talking about, and we'll touch on those just briefly today. But really, the things that were changing were on the geopolitical side. Boy, since we last met, the world doubled down.
I'm just on the call and have our annual conversation about snow plowing for this Wednesday.
Jeff, we can hear you.
There you go. Yeah, so the world's doubled down on the geopolitical risks here since our last meeting with the activity in the Middle East primarily. So keeping our eye on that, the financial risks have been higher than normal here in the last year or so, particularly since the Fed really started raising interest rates more than a year ago. The yield curve still inverted, M2 money supply is still contracting, the Fed balance sheet is still contracting. The federal government's still running $2 trillion deficits at a time when we really should be in surplus with these kind of employment, low employment. And just, all the other things that we have been talking about, with government debt at $33 trillion, so forth, so on. The economy so far has been hanging in there. Economists continue to push out the calls for recession. Fourth quarter of this year could be the closest that we're going to get. Most economists are bonds continue to be very, very highly priced. Current Schiller PE is 31, and the dividend yield is 1.6%. Those are very, very low. Stock market analysts back, some time ago would tell us that valuations that high and dividend yields that low were okay because interest rates were zero, but interest rates aren't zero anymore, they're 5%. So that story's kind of gone away, but the stock market really hasn't corrected all that much, at least from those higher levels. So that's sort of what's happening out there. Still feeling good about having some excess cash and bonds on hand, take advantage of any market swings we could get, and not really afraid of market taking off on us. Just for that, either from economic and or valuation. So I think we're sitting fairly good from that perspective. Marcia Macias will have some of our returns things here in a minute. Last two items, I want to talk just a little bit about what the strategy group has going on. As you know, we've built that team out over the past couple of years. Hired Don a year ago, hired Kyle about 3 years ago. Nino came on, I think 2 or 3 years ago. So have that team pretty much built out. We've got one more addition, and as soon as paperwork gets through SPO, we'll have a new investment strategist to introduce to you. So the team will be full then. Current projects are, we think we've hit upon a solution for our rebalancing. So we rebalance the portfolio on a monthly basis, and we get to what we're going to rebalance. We do it like everybody else, and that is using an Excel spreadsheet. But we fished around, and we actually found some really good help of importing the valuations from Brent's accounting system into that spreadsheet. So we completely eliminate the process of feeding in data into this spreadsheet. So it works much, much better. This will be the first month we'll be able to try it out, but it's to work with Northern Trust. They've been just really great to work with. Nicole has got our cash pool open. That was something a strategy group put together to consolidate all of the transactions that happened during the month in terms of capital calls and just sending out capital calls and receiving distributions. All that will be combined into a single cash pool now. That will really reduce our cash drag. We were having to hold cash balances in the private asset pools. That'll all be combined into one pool now, and we'll be able to have our overlay manager overlay that with fixed income. So that money will be effectively invested through the cash that we have to hold there will be effectively invested. That cash drag. Charlie mentioned the client support. We're able to use a little bit of Don's time for monitoring the client accounts and doing some work maybe on the reporting side to try to beef that up a little bit. We've got a couple of projects going on. One you'll see in the spring with the spring macro package on some leverage, portfolio level leverage. Mikhail produced his first risk report for the investment committee this month. We'll be reporting to the investment committee monthly on risk and coming to you all quarterly. So that's probably February will be the first report we get to you all with the so hope you look forward to that. So far he's gotten a pretty good response from the investment. We've got pacing model updates and inflow updates coming for the investment committee and maybe for this group. And then Charlie mentioned we'll be recruiting for some new positions, hopefully if approved by the legislature. For the investment team, it'll be an operations manager, which we desperately need. A cash manager. We're large enough at this point to look at building an operation there. 2 new private equity analysts to help Chris out. That portfolio has really grown, and we need a lot more horsepower there. Another analyst on the real estate and real return side for swing at it for next year. So I mentioned a new strategist. Hopefully by the end of the month. That's our plan. That person will be working primarily in capital markets, long-term capital market assumptions, some monthly data books and presentation. Just some things, not the last piece of the puzzle, but the next piece. The last thing I want to mention to you, and I need a little bit of guidance from the council here. As you know, we've got large cash balances couple of years, looks like it's drawn down to normal levels. When interest rates were zero, JP Morgan had waived the fee for managing that cash for us, but now that interest rates are up, they've reinstated that fee. It's 15 basis points, roughly is the fee that we're paying for that cash account. One option for us, in addition to looking at bringing some cash management in-house, one option for us is the treasurer's office. It's always been that way. We've always, agreed that we can invest with the treasurer, and Treasurer Montoya's predecessor pushed us to do that on occasion. But with the increased balances that we have, and the new costs that we have with interest rates up here, we think we'd like to make an investment with the treasurer's office with some of that cash. So the guidance I wanted from the council is Marcia and I looked through the investment policy. We feel like under the rebalancing rules, we have the authority to open an account and leave some cash to the treasurer's office. But I do want to ask you all, before we hit something like that, if you would like to have a more formal presentation and vote on it, or if we could just go and do it.
So let's just hear from folks.
Well, I'm, based on the challenge that we have, and you're gonna hear some more about this in one of our investments today, I'm real comfortable with the idea that Vince and his team work with the treasurer's office to get this thing done. I don't think this is unprecedented, the challenges that we're facing with the amount of capital that we have coming in. And I think it makes a lot of sense just to get it done. I mean, I'm also okay with a larger presentation, but I'm very comfortable with what Vince has suggested. And I think the investment committee next year would feel the same way.
I would say we're happy to take any money that you want. In reality, we are very grateful for the relationship that we've been able to build since January with SIC and VFA. It has been a really good collaboration, and I think teamwork makes the dream work. We have a humongous inflow of funds coming in. Treasurer's office is doing great, both on the investment side and on the rate of return for the deposits that we have in place. What we have done is we've worked with Vince and Tom Lofton and some others. We've also worked with CFA. We've spoken to the Board of Finance, Board of Finance Director Ashley Lee, because it does have to go before the Board of Finance for us to change the benchmark. And everyone working on my end to make sure that we have all of the banking in place. I guess the question before the council is, would anyone like to request a longer presentation and vote for this? There needs a guide for that.
You had mentioned, Madam Chair, that I did send Tom over, and we've done effectively our same due diligence to deal with manager.
And last, State Treasurer.
Madam Chair, it's pretty incredible. It's kind of what I did. I was even blown away a moment ago about what Ben said when he said it was going to take us a couple of years to be able to get back to a normal, what we call a quotation mark, normal pacing. And anything we can do to help simplify things makes a lot of sense to me, and make it more fit on what we're trying to do, because there's a lot of other stuff going on and just besides that. So I think that as a tool, I think that makes a lot of great sense. So
we'll report back to you on any activity. Please, my presentation, Madam Chair.
To a presentation by RBK, agenda item 2C on our August.
Thank you, Madam Chair, and good morning, everyone. Today we have the August performance summary in your book, and always we'll start off with a brief review on the capital market. On this page 28, that's up on the screen, but those of you following along remotely, page 28 should have a table on the bottom right-hand side that shows the trailing performance, trailing periods for all the major asset classes. And I think as you look at that, first thing you'll notice is that unlike July, August shows a lot of negative, a lot of red numbers down that first month-to-date column, which represents August, for nearly every asset class except cash. So not a lot of places to hide this month for August, but the same has been true for September. There's a lot of the same, more of the same that we saw for August, and October has been mixed as well, as a lot of the asset classes, particularly the ones going through some repricing. So despite a pretty strong start to the third quarter in July, we do expect and have seen most of the asset classes come in with modestly negative returns for the third quarter, and we'll bring you that full report when it's finalized, hopefully next month. And much of that can be attributed to a lot of the things we've been talking about, higher interest rates. You can see how those have changed on the top right-hand side, yield curve at different points in time. It shifted up from a year ago, which is represented by the yellow line, reasonably meaningful, but really the bigger story is just how much it's moved over the last couple years, and you can compare it to the orange and the purple lines, and you see really where rates were scraping along the bottom, which was helpful for a lot of risk asset classes, not terribly helpful when you have a big cash balance or want to look for yield in more traditional places. This type of environment, I think, is more accretive for the current situation that we're in, and it's one that we've been planning for quite some time in terms of your position. Well, and I think you'll see that as we continue to move through this environment and the performance that we'll see there. So the market expectations are really looking for higher rates for longer now. Geopolitical concerns that Vince has highlighted in the past, of course, are also creating a lot of uncertainty and have the uncertainty in the market for quite some time. So no shortage of news and items that are affecting the market, and the type of positioning that you have developed over this time, I think, has been quite helpful. A little bit more of a defensive posture. I think this month, next month, when we bring you reports, I think highlight that relative to some of the broader market indices. The only places really that are showing, as I said, some positive numbers are cash and private fixed income. Those are up about 5% on meaningful. Certainly as inflation has been coming down, it's been a little bit stubborn. Have an uptick again, but not lower than it was even. It created some opportunities in terms of having some positive real yield inflation. So, in the interest of time, happy to take any questions or comments.
I think we're going to go to Marcia, and then we're going to stop for a question. I'm going to take you to page 30. And this, just a reminder again, this is a preliminary report because in inter-quarter months, we don't have any returns for the private. So this is public, and as Matthias said, in a month or so, we should have the September, which will include both public and private. But with that said, on page 30 at the bottom, you can see that you actually, for the month, there was, as Matthias led up to, the negative return for the month of August. The total fund, if we put everything together, permanent funds and the external investors, the portfolio is down 0.94%. Now, if we look at land grant was down a little bit more, but beat its benchmark. Severance, actually, for the month, outperformed land grant, which is unusual, but both outperformed. Land grant and severance both outperformed their benchmark. Going across and looking at longer term on the bottom of page 30, you see for the most part in the annualized performance, outperformance against its benchmark, slight underperformance for the 5-year and very slight underperformance for the land grant for the 10-year. But most time periods show a positive return against the benchmark. On the top right-hand side, also a reminder of this report. There were some allocation changes, as you know, earlier this year. As Vince said, it's going to take a while to get to those target allocations. So as discussed last month, or month before, we talked about interim target allocations. What's reflected as the target in this report are actually the interim targets, and that will be the case until you get closer to your targets, more realistic benchmark for you. So as you're looking at the targets here, they're the interim targets that were discussed with you. On page 31 and 32, that's the same story. The interim targets are the interim the target is the interim target allocation. I want to point out a couple things on page 32. You'll see a lot of cash in water, but that's just a reminder that you received a significant inflow into water, $100 million. I think that is being deployed as best it can be or has been by now. You'll also notice on early childhood, just a reminder that you got a $2 billion inflow there. That's just timing. It's reflected. You also had some money go out on that fund. And then also now at the bottom on the right, the conservation legacy is showing this $50 million in cash plus it earned some money in the cash account. Obviously, cash accounts are earning now. So just pointing out there that those the higher cash balances there are money that have come in and since been deployed or being deployed. Page 38 looks at your asset class composite performance. Again, showing land grant and severance up top, and down below you see U.S. equity outperformed its benchmark for the month and has been outperforming now for the 3-year period. So the changes you've made in that portfolio have led to outperformance in your U.S. equity composite. Non-U.S. equity composite also showing outperformance relative to its benchmark for every time period shown on an annualized basis. Just a reminder, when we get to the ones that are highlighted in yellow, Tom did the structure study. So when we used to call, they were categorized by core fixed income and non-core fixed income. That has been changed and reflected effective July 1 as public fixed income and private market fixed income. Also and you'll see outperformance there on the public. Also noting on private, they were showing 2 benchmarks. The benchmark change was effective July 1st, and that's the Credit Suisse Leveraged Loan Index plus 2. The benchmark above that is, it says it's a blended benchmark. That's the non-core fixed income benchmark until July 1st, and then it changed to the Credit Suisse. So that's a blended benchmark, so you don't lose track of your history there. So that's a change. So I wanted to point out. And then on page 37, again, you'll see the zeros, and that, again, those are the private investments, and we'll have updates for you next month on those. Just very quickly I'm not going to show months, so go to 39 and just page 39 and just look at attribution. This is 1-year attribution as of the end of August. At that point, the performance was positive. If you look for the month, it wasn't, as we know, but if you look back for the 1 year, you had positive performance and you beat your benchmark, as we showed earlier. For that year, you remember it's very hard for you to state your target allocation. So the tactical asset allocation shows a negative there. That means you weren't at your policy index. And we know why, but it was a headwind for you because for a good portion of that, equities were doing well, so you didn't have as much equity in your portfolio as target, so that was a headwind. But for structure of your asset class, that was a positive, as well as manager skill was a positive. So manager skill and structure led to your outperformance of your benchmark for the land grant. Lastly, just another change to the report on page 44. With the structure study, these are all fixed income, so you see the public market fixed income composite, and underneath that, some sub-composites. You now have the short duration cash management composite, the core bonds pool, composite and the credit plus pool composite under the public market, heading. And then private market, you can see. And then there's those assets that Tom and his team are redeeming, and we are reflecting those separately as well. So, Madam Chair, with that, we'll take any questions.
All right. Council members online?
And we could probably sit here, Madam Chair, we could sit here for probably a day to talk about it, but with all of these unprecedented things sort of at play right now, with a lot of cash on hand, and also a pretty inverted yield curve, and I understand this week we had the 10-year note over 5% for the first time since 2007. With all of those things happening, are there advantages that we can take right now? How does that inform our strategy? I know it's a lot, but whatever you can tell me in terms of just a quick response on that, like your thoughts and comments.
Madam Chair, the main thing that we're doing is, so we've got this excess of cash and bonds over our desired allocation. So we'd rather have, zero cash and land grant effective. Long term, with normal situations, that's got a lot more than that now. So the main thing we're doing is, with that excess cash and bond, we're just watching market rates that we can earn on cash and what we can earn on 10-year. And we're still expecting to hit a recession in the economy. Normally, rates at the 10-year duration normally fall 2 to 2.5 percentage points from wherever they are. When you hit a recession, wherever the 10-year is, it falls 2 or 2.5%. In fact, historically, that's the on average. So we watch if over the next year we do get into a recession, we expect the 10-year to fall 2 to 2.5%, about 35% capital gain. So big gain in those bonds to fall to that level. We handicap a bit. Are we going to get into that recession? I think I've got the model plugged into the model right now, 4%. So it just does the calculations of if there's a 40% chance we hit a recession and interest rates fall 2.5% percentage points on the 10-year, better to own cash right now at these rates, or is it better to own bonds and capture that capital gain, right? Because all those calculated, we move between bonds and cash depending on the rate. So we moved a little bit more into bonds here when we rebalanced the last couple of months because of the 10-year, at higher rates relative. Cash is held pretty steady. 10-year rates. We've actually moved a little bit more towards it. There is a little bit of management in there. Certainly not calling the market. It's just a math model that says it's worth more to do bonds now than cash. But just by the math. That's the main thing we're doing right now. So the other thing is, we're very active with our pacing models, make sure they're updated with our most current inflow assumptions. And then it's always working, underneath to get new data in. So we have a really good idea of how we need to pace, and that's really risen a lot. You guys will get a real package. So we'll keep close attention to that, and the asset class directors are very aware of starting to adjust the size of the investment.
On to item 3, and give our investment committee.
Thank you, Madam Chair. We had as has been the case, and I'm certain it's going to continue to be the case, a fairly long and reasonably involved meeting. What I'd like to do is call the council's attention to just take a quick moment before we begin. When we get to the end of the voting matters and the items on the agenda, 3G is a new program And I just want to make sure that the council, understands that this, particular, you'll hear a fairly significant amount of discussion about it. And this is just another, attempt for us to be able to try to figure out a way to more quickly and efficiently invest these massive funds that we have. And, I think that when you get a chance to cover that, we've spent a fair amount of time on that at the investment committee meeting. And I think my opinion is this will be the first of, actually, not a number, but a reason.
Hello?
A reasonable number of,
We can hear you.
a reasonable number of efforts like this to be able to try to figure out how to, again, more efficiently and easily get these funds invested. So I think I just want to make sure we know that's what's coming at the end of it. This is the private equity show today. This is primarily, I think every voting item is, other than 3B is, and 3C, have to do with our private equity program. So I won't belabor the point. We'll get started and let you move us forward with 3B.
Not to dismiss your
Thank you very much.
All right, let's move into our voting items. We're going to first hear from our Director Lawson on investment item 3B, Silver Point Distressed Ops.
It's a very long frame, second. Yeah. So, Madam Chair, thank you. I apologize. It's one of those days where I got here, reached back for my laptop, and it wasn't there. It's back at the office. So I apologize. So I'm going to go a little bit off notes today. I believe we're on page 58 of your presentation materials. This is a recommendation by staff, along with the Makita, for a $250 million, up to a $250 million commitment to distressed institutional,
Community Institutional Partners.
yes, distressed opportunity institutional partners, 2. Along with me on this presentation is Mary Bates, from Makita, first of today. Tad Ferguson, I believe, is online with us. And then we have from Silver Point, we have Ed Moulet and Yves Pesh, both general partners and owners of Silver Point to present as well. So I'm gonna do a couple things. First off, I'm gonna just describe this broadly, and I want for some carryover from our earlier credit committee meeting last week. I'm going to bring up a few of what I thought were sort of thoughtful points by the credit committee members. One, I believe that you can broadly think of this strategy, although it's not completely in all markets going to be dry powder, but it's more or less going to be very broadly sort of a dry powder type of an allocation that's going to be sitting there waiting for liquidity or distressed events to occur. I think of, what's the purpose of fixed income in this, in the broad SIC portfolio? Really, it's the portfolio as a whole. All the various asset classes are meant to work together so that we can create some sort of steady state return through all, for lack of a better phrase, through all environments. And fixed income as a microcosm really tries to do the same thing. Now, one of the committee members brought up, at the credit committee members brought up the fact that, well, you're going to hear at least Chris Cassidy gave has a very thoughtful write-up this month on J-curve risk and just the amount of cash and the amount of investing that we have to do to put money to work. I believe it was Treasurer Montoya that brought up the fact, well, what are we necessarily doing allocating to a strategy like this where it's dry powder? We need strategies that are going to put money to work. And yes, that's absolutely true. But from my perspective, And what Vince can back up and then tell us to your point earlier, I personally am all about structure. I don't try to make macro calls. I've seen too many smart people make poor macro calls. So I personally am all about is that at any point in time, the portfolio appropriately diversified so that whatever environment comes along, we'll be ready for it. This is one of those. So very broadly, the portfolio, the fixed income portfolio is allocated direct or cash flow lending, collateralized, asset-based, or it's got a direct route to a specific asset backing it, or the smallest allocation, which is the combination of special sits, distressed, and capital solutions. That's kind of where this sits. This is for those very episodic environments when you are going to have liquidity events, when you are going to have high distress events, and we're going to have the dry powder to step in and take advantage of those and create investment opportunities in those environments. So that's really how this sits, and it's why, despite the fact that we have a lot of dry powder that we need to put to work, it's important to have this strategy as part of the overall mix. So really broadly, that's why this is sitting there. And then secondly, I think it was Member Ulrich brought up, well, what about liquidity? This is a $250 million allocation. What if it needs all of its money all of a sudden? Are we planning on liquidity? I believe on page 44, you'll see the public market exposure that we have in fixed income. Essentially, that public market allocation is a liquidity allocation. The broad purpose of fixed income is to essentially be the put in any down market. We can put a price to the market that's a fair price. I wake up every day and I look in the mirror and say, be the put. But that's really, that's why it's there, and that's what that entire liquidity allocation. Now, it's a spectrum, but really all of that is there. I sit down with our staff on a weekly basis with Nino Carpenito. The strategists meet on a weekly basis, and I meet with Nicole Gallegos in our accounting group, talking about what are our inflows and outflows, what calls do we expect to make, what are we expecting over the long term, and we work with the pacing models that Nikita has to help us understand long term, how do we, within the fixed income portfolio, the public side, how do we arrange those exposures so that we can be ready at any point in time, including in the future. So I thought those were two good points that were brought up. So I just wanted to answer those, and I'm going to turn it over to you to talk about Silver Point, and then we can have Silver Point speak.
Great. Welcome. Thank you so much. I appreciate it. Excited to be here in person. So this is a re-up for the committee. So you are an investor in the preceding vintage. This is a re-up of the fund. So the firm Silver Point, well-established, long-standing well resources. It was founded in 2002. It manages $24 billion, all in credit-related investments. So $9 billion in a hedge fund, $10 billion in what they call specialty lending, which is a non-traditional direct lending fund and strategy, which you are also an investor in, as well as $4 billion in distress. Since its inception in 2002, the manager has deployed and invested close to $123 billion. And in this strategy, across the two previous vintages, returns have more than met expectations. So the return expectations for this fund, what they're targeting, is a net IRR of 15% or above, and they've generated a return in excess of 20% on a net IRR basis. Well-resourced, 275 employees, including over 90 investment professionals. On the term side, there are no changes, no meaningful changes to note from the previous vintage. I won't go into detail in terms of what those terms are, as we are in public session. As it relates to the strategy, again, this is a re-up for the fund. It is a distressed investment fund. How the GP describes it, and we'll let them go into greater detail around it. But the investment approach, they're looking for fat pitch opportunities in terms of credit market dislocations, meaning you should expect to see more capital deployed quickly in the event that there's a credit market dislocation and that there are sales of quality assets in the secondary market. So during those periods of time, you would expect to have more capital called. They're also looking to take advantage of corporate restructuring, illiquid portfolio sales, and process-driven opportunities related to restructurings and liquidations. They will take controlled positions. We've already highlighted the performance at a high level. Again, the manager has met or exceeded expectations in terms of their previous vintages. To quickly highlight the strengths as well as potential concerns that we've identified with this investment offering, from a strength standpoint, we do believe this strategy in particular benefits from the broader $24 billion of the larger organization, including the hedge fund strategy, which means that they're active in the market on a daily basis. We do like the flexibility. I think Director Lawson called it a put option. We like the optionality associated with capitalizing on a market dislocation. We would also highlight that we like the diversification for a distressed strategy. You should expect to see 40 to 60 positions of significance when this portfolio is built out. In terms of potential concerns, we've already addressed the potential slow pace of capital deployment. We think it's mitigated. It is both a positive and a negative. You always want your investment managers to be disciplined, but we do believe it's consistent with what CIO Vince Smith outlined, that it is likely that we're entering a period of greater market uncertainty tied with potential for greater distressed opportunities. The manager is raising a higher target fundraise, than the previous vintage. They're targeting $4 billion. But if you look at the past two funds on a combined basis, it's not a meaningful increase, and so we don't have significant concerns in terms of deployment. We would highlight that this firm does have limited minority as well as female representation, particularly at the senior levels. We understand that they're taking a number of steps to address that, but we would bring that to your attention. It's not atypical for a firm of this vintage. Again, they date back to 2002 in terms of their inception to have the representation that they do have, but they are taking steps to address it. As a distressed fund, it is possible that you will be reading about some of the investments that this manager is doing in the Wall Street Journal as a public entity. That may raise some concerns. That's not unique to Silver Point in any way. It is something that is just associated with distressed strategies. So with that, happy to take any questions or to turn it over to the investor.
I think we're going to hear from Silver Point first.
We are. Eve, would you like to, Eve or Ed, I'm not sure which of you want to go first.
Sure, we're both on, but I think Ed is going to take the lead in leading you through sort of the background, the strategy. I just want to say we're really grateful for the longstanding partnership. Thank you, Tom, Barry, and the entire board.
Great. Thanks, Eve. And good morning, everyone. And thank you all for your time today. Eve has been at Silver Point. Eve is my partner. She's been at Silver Point since 2003, leads our investor relations and marketing team, as well as been the point of contact for you all during the duration of your investment with us. Along the lines of what Eve said, I wanted to say we value our longstanding relationship with New Mexico State Investment Council. We appreciate your continued support of Silver Point through your allocation within the distressed strategy as well as your direct lending strategy. And we're very pleased to be presenting to you today. I thought I'd start with a very brief overview of the background of the firm, our investment philosophy, and importantly, why we're launching the fund today, which is the market opportunity. And then, of course, I'd love to open it up to Q&A if you would like. As some of you may know from prior discussions, I founded Silver Point in 2002 with my partner, Bob O'Shea, and we continue to run and manage the business together today. Prior to that, I had spent my entire career, and Bob had spent most of his at Goldman Sachs, where we built and ran Goldman's global distressed and special situations business. We formed Silver Point in 2002 with the vision to create a world-class credit investment firm with specialization in distressed and special situations, distressed and special situations, corporate credit investing. When we set the firm up, we sought to take advantage of the natural inefficiencies that we saw that persisted, particularly in distressed corporate credit space, and to set up the firm in a way to be able to effectively harvest that. What we liked about the space was you had non-economic sellers, information is opaque, and the process tends to be complex. Successful investing in the space requires the ability to understand companies, industries, capital structures, legal processes, jurisdictional issues, as well as having the resources to actively manage and drive the process to create value. Today, after 21 years or over 21 years since our firm's launch, Silver Point manages about $25 billion of investable assets, as was mentioned, and we have over 300 people with over 100 on the investment team. And as was mentioned, we've invested about $125 billion in distressed and special situations assets since inception. We launched the distressed drawdown vintages in 2017 and 2019, respectively, as we believed we were late cycle, and we recognized from our deep experience that having dry powder to take advantage of the opportunity set is highly attractive. We knew that having dry powder allowed us to be more offensive and capture all facets of the market opportunity, as we could allocate capital at the most attractive times, allowing us to take advantage of the broad range of opportunities that come out of a dislocation. And that proved correct when you had the 2020 COVID dislocation. The core of our strategy is investing in process-driven, event-oriented, distressed opportunities. However, we also will capitalize on market dislocations, special situations, and idiosyncratic situations. Our fund invests across industries and up and down capital structures, from senior secured debt through equity, and that would be typically post-restructured equity. We often invest higher in the capital structure, as it tends to be where we see the best risk-adjusted returns. We like the downside protection that being higher in the capital structure tends to offer, as well as how it positions us to lead and drive restructurings. We invest in large, mid, and small cap companies. And even as a larger firm, we've always believed in investing in mid-sized companies, provided they have higher anticipated risk-adjusted returns. We find these opportunities to be less competitive, primarily because people typically of our size don't focus on them because they feel like they can't invest at the scale that they want to invest at. And then we're able to bring to bear resources of a large firm to really drive these mid-sized situations. And over history, we've been able to create real alpha for LPs in doing that. The fund targets about 40 or so meaningful positions. In our Distressed Opportunity Fund 1, of the $2.5 billion of commitments raised between the two funds, we invested close to $7 billion inception to date through recycling and reinvesting, with the onshore fund generating a little over a 20% net IRR and about a 1.6 times net multiple of money to this point. We're raising the next Distressed Opportunity Fund because we think there's going to be a real opportunity in distressed investing in the coming years. If you turn to the market opportunity, today's macroeconomic backdrop is significantly different than it was in 2017. When we raised the first fund, we told investors we felt we were late cycle, and we didn't know what would cause it or when, but we had conviction that you'd see a market opportunity at some point over the life of the fund. As we now raise Fund 2, the current market backdrop creates, we think, a compelling opportunity in the more near term. I thought maybe it made sense for me to spend a few minutes outlining what I think some of the key market drivers are that sort of inform that view. First, inflation is driving the largest set of risks to the market, and as everyone knows, has been persistently elevated, not just here in the U.S., but globally. And many central banks have increased interest rates, and we have and continue to believe that the Federal Reserve will need to keep interest rates higher for longer. At the same time, you also have continued global monetary policy tightening beyond just in the form of higher interest rates, but also in the withdrawal of liquidity, particularly in the U.S. and in Europe. And you're also seeing slowing global growth, which is one of the impacts of the rising rates and the decline in liquidity. Wage pressures, we think, will also continue to impact margins, and higher rates will also, we think, eventually impact consumer demand in the U.S. And I'd also note that commercial banks are now also pulling back significantly, particularly since the SVB situation unfolded in March. And all that tightening should result in weaker economic growth, but with an uncertain lag. That lag has been, we think, made longer by all the fiscal stimulus that the U.S. government did during 2021 and 22. And so that's what we think has sort of pushed the opportunity into 2024 or 2025. And then plus, we think oil prices have turned higher, and even before the situation that's unfolded in Israel, and that even before that point in time, we thought created risk to markets. And lastly, even again before the Middle East situation, we thought geopolitical risk had now increased, and that would ultimately further tighten financial conditions. And we believe that confluence of factors will create pressure on corporate earnings and margins, which we believe increases the risk of a global recession. Our base case remains that we'll be more likely than not to have a recession over the next year or two, and that should lead to heightened volatility and a steady stream of opportunities. My own view is that I'm more likely than not that we'll have a recession in 2024. So that backdrop exists in the context of tremendous growth in the credit markets and the weakening of credit quality of the leveraged finance markets. Since 2008, the global leveraged finance market has expanded by almost 2.5 times, growing from 1.7 trillion to about 3.9 trillion, and that doesn't count about $1 trillion or $1 trillion plus of direct lending. Given perpetually low interest rate environment that we had prior to the interest rate increases in 2022, the leveraged credit market had evolved into one that I would characterize by higher leverage, lower quality adjusted EBITDA because of generous add backs and definitions, permissive documentation, and a lack of interest rate hedging requirements, which was a change from what it was, say, prior to maybe 5 or 7 years ago. All that has led to weaker credit and lower credit ratings on average. The market share of lower credit, late-rated credits in the leveraged loan market has increased significantly, with 25% of that index rated B minus, up from 5% in 2008. The technical backdrop, combined with weak credit quality and tightening financial conditions, we think could lead to substantial downgrades of B minus credits. That's particularly interesting because about 70% of the leveraged loan market is held by highly leveraged CLOs that basically manage to ratings. And this means that if companies start to face pressure and they get downgraded, that those companies that get downgraded to triple C plus, or those credits that get downgraded to triple C plus, and weak double Bs could create a forced selling dynamic among CLO holders, which creates an attractive buying opportunity for people who look like us. Taking all of what I just said together, I think the market backdrop for an opportunity in distress and special situations investing is quite compelling, and we're excited to partner with you and take advantage of that for you. We're very excited about the launch of Distressed Ops 2. And with that, I'll say again, thank you, and be happy to open it up to questions.
Questions from council?
Madam Chair, I think this is a perfect example of the kind of flexibility that we're working on trying to develop. And I think that the investment committee unanimously recommends approval of this investment. With that in mind, based on the recommendations of the Council Investment Committee, Consultant Makita, and SIC staff, I move the State Investment Council approve a commitment of up to $250 million to Silver Point Distressed Opportunities Institutional Partners 2, subject and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork. Second.
Okay, we got a proper motion by member Lavender, second by member Bingaman. Any discussion on the motion before the council? No, Madam Chair, I would just like to know, actually, I would like to ask the question. It was stated about the diversity within your agency and that you're working on it. I'm just curious, what are you doing to assist that?
So we have a number of programs internally in order to boost our diversity. We have summer analyst and associate programs to bring in diverse candidates with internships and so forth, even where we wouldn't otherwise have internships. We do that at the college level, and frankly, we also do that at the high school level, where we bring in diverse candidates to give them a sort of feel for what it's like to work at an organization like ours, even though it's a long time before we'll ever hire them because they've got college ahead of them and maybe business school. And then we have, as I mentioned, we have targeted hiring in terms of making sure that we're expanding our network to see the largest amount of diverse candidates that we can, both on the candidates. We typically don't actually hire out of undergraduate, but when we typically hire is when someone is 2 years, and this is for the investment side of the firm. On the non-investment side of the firm, we do, and we do this there through the school recruiting process, but through the non-school recruiting process, we have that target to try to find people young and then bring them in, train them, and so forth. And we have a number of programs that we pursue along those lines. I know, Ed, Eve, would you add anything else?
No, I think there's also, I would mention, that that we have a lot of women networking and dedicated programs within the organization for ongoing training, mentoring, and development, as well as promotion.
And if there's there's a sort of a directive that I've given to our HR department on the investment side, if there's anyone who's a diverse candidate who is close but isn't going to get over the line, that they should get them in front of me. And I normally don't I only normally interview the more senior people, but on the junior levels, they've been given that directive.
I'm not sure if it's too late in the game, but as far as the summary of the partnership terms, I'm not going to say anything. But the key provisions on both of the core folks, I would appreciate if one of them were to leave, that SIC would be informed instead of only if both leave. That is.
Okay. And Treasurer Montoya, at this point, when the council approves, the legal docs, the legal due diligence is yet to be done. So we always have room to, if we want to, add our own stipulations to our sign letter. We have that flexibility. So we can take things like that into account. Absolutely.
Mr. Land is taking it. All right, hearing no further discussion, can we take a roll call motion? And just for the folks following along at home, this is a $250 million investment in Silver Point Stress Opportunities Institutional Partners.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
EFA Secretary Wayne Probst.
Yes.
Catherine Allen.
Yes.
Nick Tejas.
Yes.
Don Bingaman.
Yes.
Harold Lavender.
Yes.
Motion passes 7-0.
All right, great. And we thank the folks from Silver Point for being on with us. Could we just
Thank you.
your next presentation? I just wanted to say I'm very happy to meet you in person. I got to meet Marcia and Amy as well at the Southwestern Regional Institute. But I will say, when I first started as treasurer, reading all of your documentation, it's very thorough and very fair, and it's very honest, and it gives us an opportunity to really look at all perspectives. And so I appreciate that line that you keep between your work and, whatever the deal is. And so I just wanted to make sure you knew that I do read your stuff, and I appreciate, what you.
Thank you. We appreciate that. Thank you.
On agenda item 3C, and this is a contract amendment.
This is a contract amendment for Nikita, and to along with me on this presentation, once again, is Mary Dates. Ed Ferguson, I believe, is online with us if there are any questions on pacing, but I think there are really just two broad points to make on this. One, as the portfolio has grown, the need for diversification within the portfolio has grown. We want to start adding more specific real estate strategy, real estate debt strategy, not equity strategies. We're not taking Keith's world, but debt strategies into the overall portfolio. That needs additional bandwidth and needs additional manpower on Nikita's part. Number two, when we first went out for our RFP in early 2022, our pacing, the amount of money that we need to put to work annually, has more than doubled, and I suspect it will go up even further with the update that you're going to get in 2024. So honestly, the old 150 is now the new 400, or the 400 is the old 150. What you're going to be, those are the kind of size of potential commitments that we're going to be bringing in 2024. So, with each one of these, to Chris's point at the last meeting, it's a bit overwhelming. Nikita does a good job of bringing the broad swath of alternatives available for the SIC and for the fixed income portfolio. I'm also doing my investigative work alongside of that. I have a fiduciary duty as well, and frankly, it can be a little bit overwhelming just when you're monitoring existing plus looking at all the new possibilities out there. And it's really great that we have we do have the support that we have. I guess Ron McCauley is. I am very thankful that we can have a fixed income analyst that came from the asset management side that understands public markets to help me, to support me on that side. So just those two broad points are the amount of work that we have, the amount of money that we have to put to work has significantly increased, and the diversification that we want to, new levels of diversification we want to achieve in the portfolio is going to require more manpower. Now I'm asking that we don't put what the new is on, but that is why staff is requesting a contract amendment for Nikita to support us along the farm.
We do have a presentation, actually. We appreciate the opportunity, appreciate your comments as well. So, expanding the relationship to include commercial real estate debt. So this was part of our opportunities. It's part of our 50-plus person private markets team, but we have a 10-person dedicated team to commercial real estate. So for us, real estate is both debt as well as equity. And so actually, we wanted to introduce you to another member of the Makita team, Reggie Ross. Reggie, do you want to turn your video on? Oh, great. And so Reggie actually is a senior member of our real estate team. We wanted to provide you with a quick overview of our capabilities in real estate. He will be part of the client service team for the New Mexico State Investment Council and talk you through some of the clients that we work with, as well as the broad approach that we have to real estate debt. Again, this is part of our broader private market. Great, thank you. Mr. Ross.
Good morning. Thank you for your time, everyone. Again, my name is Reggie Ross. I am a professional on the real estate team at Makita. As Mary said, there are 10 real estate professionals on the team, all dedicated to real estate equity and debt. And we are strategically placed across the US. I sit in Chicago, but we have team members on the West Coast and on the East Coast as well to make sure that we have pretty comprehensive manager coverage, and so that we can help you continue to build out the portfolio. I don't know if you have the presentation slides in front of you, but if you do, going quickly to slide 145 is a list of representative clients. I won't go through and name the names. You can see the names in your presentation materials. But just to let you know, we represent all scope of clients in terms of size, in terms of investment strategies, from the absolute largest clients in the US down to clients with less than $1 billion of assets under management. And so we think the combination of our client exposure and the experience of the team allows us to really be super helpful to you and your team in terms of putting together a portfolio of real estate debt opportunities. Flipping quickly to the next slide, on slide 146, this is just a representative list of clients, or excuse me, of managers that we have worked with and recommended to clients over the years. Specific to this mandate on this list, if you look at the bottom left-hand corner, Berkshire is one of the managers that is currently in your real estate debt portfolio. We work with them pretty closely and know them very well. So again, bringing the expertise to bear from 10 professionals scattered across the US, we think will be really, really helpful for your portfolio. And then finally, not to take up much time, on 147, this chart is a bit confusing to sort of look at. There's a lot of information and data points on it. But the key takeaway from slide 147 is that in the instances where Makita has chosen investment partners and investment funds for our clients, we have done pretty well at that exercise. So those are the pink squares that are represented on the table on slide 147. And essentially what that shows is, by vintage year, the returns of the funds that Makita has selected versus, and it's not a complete apples to apples comparison, but versus the time weighted returns of the NCREIF Odyssey. That's the NCREIF Odyssey is an equity only index, but the pink squares on the table here represent equity and debt investments that Makita has chosen. So really appreciate your time. I want it to be brief, but thank you for allowing me the opportunity to introduce myself. Looking forward to working with you and the team more comprehensively in the future. Thank you.
And I should have mentioned Reggie's background. Reggie is a lawyer by training. He's actually not a consultant. He just made the transition over. He was with the state of Washington for a number of years and actually had an operating background before that. So Christy Fields is the lead of our team. She has close to 30 years of investment experience. She went to Yale to get her master's in real estate. Built a team that has a background on the investment management side, on the legal side, as well as on the consulting side. So we try to have a good cross-section, and Reggie's background is, again, he's a lawyer by training.
And Reggie, my apologies, I should have mentioned your name when I introduced everybody earlier on, so sorry about that.
No worries.
Thank you for being with us.
Thank you.
Questions posted
real estate grouping. How much are we putting into the real estate, sort of the big picture of it?
Sure. Well, we're on the one hand, Reggie mentioned the Berkshire strategies that are in real estate debt strategies that are in the SIC portfolio. Those are actually when Keith Sable presents his real estate structuring programs, those real estate debt strategies are going to be transferred to credit. So there's the four strategies that will need ongoing monitoring. In addition, we have ACOR, which is also an existing real estate debt strategy, which is more opportunistic in nature. So that's, those are 5 strategies right there. And then as far as new investments go, I anticipate right now, based on pacing, I would say 3 to 4 commitments per year for real estate. And Treasurer Montoya, it is part of it. There are 2 things going on. Number one, as the portfolio has grown, there needs to be more specific focus on real estate backed debt strategies as part of the overall diversification. And then secondly, just the new commitments that will be needed to bring forward. Those will need to be due diligence, and Reggie's going to be your kind of like Mary is for the private credit. Reggie's going to be the face for those real estate opportunities.
I mean, how long this is for? Yeah, when does the Makita contract come up again?
So the overall contract was just approved, 5 years, was just approved last November, I believe it was.
Maybe in August 2020. We'll have the additional 4.5. Questions?
Madam Chair, based on the recommendations of the Council Investment Committee, SIC staff, and the general fiduciary oversight of RBK, I move that the State Investment Council approve the amending of the Makita consulting contract to expand coverage to include real estate debt investments and to reflect increased commitment requirements under terms memorialized and discussed at today's council meeting.
Okay, we've got a proper motion by Member Lavender, a second by the Treasurer. Any discussion on the motion before the council to amend the Makita contract? Hearing none, let's take a roll call vote.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
CFA Secretary Wayne Probst.
Yes.
Nick Tejas.
Yes.
Catherine Allen.
Yes.
Don Bingaman.
Yes.
Harold Lavender.
Yes.
Motion passes 7-0.
All right, and Mr. Ross, we welcome you to the team. We're very much looking forward to working with you and the rest of the folks. Yeah, thank you so much.
Thank you.
Thank you.
Move on now to the TE show.
That's right.
Mr. Cassidy and Mercer. We're going to start with agenda item 3E, Alteris 6.
Morning, everyone. So this month we're bringing 3 investments. 2 of them are middle market buyout managers, which is really effectively the core of our private equity portfolio when you look under the hood. And the 2 managers we're bringing this month have a little more of a value orientation, which we like. One's a re-up, one's a new manager. The other is an early stage venture capital fund focused on consumer and consumer tech. On the VC side, our focus really remains on slowly and methodically building out an early stage portfolio on that side of the program. In terms of Alteris, we're recommending commitment up to $75 million to Alteris. It's 6 funds. It's a middle market buyout fund focused on the healthcare industry, specifically companies operating in following 4 industry verticals: pharmaceuticals, medical devices, life science and diagnostics, and healthcare services. Alteris tends to invest in picks and shovel businesses that support products and services that really are deciding to outsource some of the manufacturing or services to these
Alteris will be a new relationship for the national program, and it will fit into your buyout segment of the portfolio. Alteris is a well-established firm. They were founded in 2002, so they have a 21-year track record, and they've executed the same strategy over that time, which is really important to us. They focus on investing in healthcare and healthcare-related companies, and they continue today to be led by two of the co-founders, one of which we have. Plus, they have a senior team that includes 4 managing directors. So a really solid senior team is leading this investment strategy. Again, they've been cycle tested. They've been doing this strategy for 21 years, and they're focused on companies that seek to improve patient outcomes, improve access, and efficiencies. And we also really like their operational focus. So when they're looking to build value in these companies, they're doing it through a multitude of levers that's really benefiting the growth of the company. They have, lastly, a very strong track record, low loss ratio, and they have a 5-fund track record, again, that's been executed over a 20-year period. So we are recommending up to a $75 million commitment, and we'll turn it over to Dan Tolley from Alteris.
Good morning. I'm Dan Tolley, founder of Alteris. It's both a pleasure and a privilege to be here. A pleasure because one of our best investments is Oso Bio, which is headquartered in Albuquerque. And so we have fond memories of having a company here in New Mexico. And it's a privilege to represent Alteris. When we founded Alteris a little over 20 years ago, we had 3 fundamental or guiding principles. 1, industry specialization. 2, to be investors, not asset managers. And 3, to build a culture of excellence based on respect for the individual. If you like to yell and scream, we're not the right partner. Our success is largely because we treat people well, and we expect to treat all of our portfolio companies, all of our partners in the same way. In terms of industry specialization, we're 100% focused on healthcare. We think it allows us to do 4 things better. We think we could source transactions better. We have a very proactive calling effort on the corporates. A number of those relationships go back over the last 20 plus years. And while you can't necessarily time when a company might do a carve out, by virtue of that active dialogue, we're in there, we have a seat at the table, and we have a right to win. In terms of due diligence, we leverage our operating partners and our network of relationships to enhance our due diligence process. We think we can add more value at the portfolio company level when we own the asset by virtue of not only our operating partners, but we've coined the term Alteris Business Systems. To kind of hit our returns, we underwrite to a gross 3x and a 30% IRR. In order to do that, you not only have to get the investment right, but you have to get it right in the right time frame. And so it's not enough just to buy something right. You've got to add value, and you have to add value quickly. We're very much of the view that you can't shrink your way to long-term prosperity. We have to ignite growth in these companies. Our average portfolio company has more than doubled its EBITDA over the course of our ownership. And then lastly, we think by being healthcare specific, we can exit deals better. We often find exiting is an undervalued skill set in private equity. Anybody can buy a company. It's the ability to exit. And our track record is pretty easy to get your arms around. It's dollars out and dollars back. Of our 50 investments, we've already had 34 significant realizations. So that's a bit of an overview of why we think industry specialization is so fundamental to our success. Secondly, we view ourselves as investors, not asset gatherers. George and I were the largest investor, largest LP in the fund at 10% plus. We abhor capital loss. We can't imagine a better place for us to put our own capital than investing in the opportunities that we have in front of us. And if you buy a company at a good value, you can add value while you own it, and you have an opportunity to develop the exit strategy before you buy it. Our view is our worst investment gets our money back, We're gonna have some 2 and 3Xs. Every now and then, we might do a little bit better, and we're gonna hit our target of a 3X gross fund. And then lastly, our culture. We've got a lot of diversity of backgrounds and a lot of diversity of viewpoints, but we have one moral compass. We treat people with respect. We expect to be treated that way. And we want everybody in the firm, doesn't matter what title, to have an opinion every day. It doesn't have to be right or wrong. They just need to be it needs to be rational. Because you can't come and say, I don't like that deal because it's a Tuesday. But if you say, I don't like that deal for these 5 reasons, now we've got something to talk about. And the more we hold things up to the light, the closer we're never going to have perfect information, but the more we hold it up to the light, the closer to the truth we're going to get. And so if you don't have weekend plans, I can keep going, but that's a quick overview on our Harris, and happy to answer any questions.
Mr. Tully?
Yes, I am.
Okay, very good. So questions from council? Yes, Member Hill.
Madam Chair, Mr. Tully, I really appreciate your remarks on your leadership philosophy and your management efforts. I think that goes a long way and does offer up a competitive advantage when you treat people right, with work. I just want to know, how do you look at sort of this long-term investment that, the SIC is going to allocate over years with such dynamic shifts in the economics of healthcare and governmental sort of things that go on with funding healthcare, not funding healthcare? It's been a wild ride, and then you add on top of it all the real steep increase in inflationary costs in healthcare. How do you look at all of that?
Sure. It's you'll find in healthcare that themes tend to be fairly long-lived. We do like the complexity of healthcare because it makes it more difficult for what we call healthcare tourists to make investments in the sector. A lot of generalist funds typically can't get these investments through their committees. When we look at, we don't like providers. We don't like to fly too close to the sun. We like to be one step removed, more of the, as Chris said, more of the picks and shovels. We do a lot of contract manufacturing, both in the pharmaceutical as well as the medical device sector, where we don't care what gets through the FDA 10 years from now. We want to be the ones that make it. An example of that would be Oso Bio, which was in Albuquerque. We made cytotoxic, very difficult to produce drugs that are used in cancer settings, as an example. So the need for quality is extremely high. You have to be willing to call a foul on yourself if you make a mistake, because people's lives are at risk. So while we own that company, which was part of making drugs for the primary pharmaceutical company, we looked at the supply chain, and one of the things we saw was getting product that last mile was very difficult. So we kept digging a little bit deeper on the supply chain, and we found that 80% of the drugs going through the FDA are temperature sensitive. And so we looked, okay, how can we do a better job in terms of getting those products that are temperature sensitive to the marketplace in a way that doesn't reduce the efficacy? Because most of those drugs are +2 to +8. Every time you go outside of Celsius, every time you go outside of that range, it's called an excursion, and it has potential to negatively impact the efficacy. So we found a wealthy family in Ohio that has gone to Africa on a mission, and they saw kids were dying not because the vaccines couldn't get there, but because they arrived and they were corrupted. And so only a wealthy family could spend the money to start something like that and to build it to scale, because you need to get to scale in order to have enough containers to move drugs globally. And not only is it an FDA product, every route you fly has to be approved by the FDA, but it's also an FAA, because because the containers we're shipping these in, they're pallet size, 1 to 4 pallet size containers. Each one of those containers has motors on them, and they're going into the belly of a passenger plane. So there's really strong consumer protections in terms of maintaining the integrity and fire suppression systems. And so that was just an example of how one investment led to another investment, which turned out to be a terrific opportunity. And we look at it, no matter what happens across healthcare, those products need to be moved, and they need to be moved in a way that maintains the integrity of the product. So that's just maybe more than you wanted to hear, but that's kind of what we're trying to do to make sure that we're improving patient outcomes. And also, you can't have a product that improves patient outcomes but hurts the doctor or hurts the provider or the payer. It has to be something that addresses all those constituencies in a positive way. If you do that, no matter what happens, you're going to have a seat at the table.
Thank you, Ben.
I have to say that's refreshing to hear. I wonder if we should be asking all of our managers, are you willing to call a foul on yourself? Have you ever called a foul on yourself? I mean.
Right.
We shut down the facility in Albuquerque for 2 weeks.
So you're saying that you have experience?
We shut, the one here in Albuquerque, we shut down for 2 weeks because we found a moth. One moth. And, it's, you know, you're playing with people's lives when you're producing this. And, we had to do a complete analysis of how did that moth get there? You know, somebody could have picked it up and put it in their pocket and nobody would have ever been the wiser. But that's not what you do. And it's what you do when nobody's watching that's important.
Lessons for everyone. Other questions from council? Motion? On the recommendation of the Council Investment Committee, Consultant Mercer, SIC staff, and General Fiduciary Oversight of RBK, I move that the State Investment Council approve a commitment of up to $75 million to Alteris Health Partners, LP, subject and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiations of final terms and conditions, and paperwork.
Second.
Okay, we've got a motion from the treasurer, a second from member Caius for a $75 million commitment to Alteris Partners 6. Any discussion on the motion before the council? No discussion. Can we take a roll call vote on that motion?
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
CFA Secretary Wayne Probst.
Yes.
Nick Teas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Harold Lavender.
Yes.
Motion passes 7-0.
Great. Mr. Tully, we appreciate you being here with us.
As I said, it's a pleasure and a privilege. Thank you.
Thank you.
Thanks a lot. Thank you.
All right. Let's move on to agenda item 3E, and it is M13 Ventures 4.
Yes. Thank you. We're recommending a commitment of up to $50 million to M13 Ventures 4. It's an early stage venture fund with a focus on investments in consumer tech. Specifically, they invest in the enabling technologies that power the future of money, work, health, and commerce. Include software businesses, marketplaces, and ticket-level businesses. I said that again. Powering consumer behavior. And what we really like about M13, I think it's reflective of what we're seeing in private equity. This is a $400 million fund, and the firm has built a 45-person team, 5 operating members for this fund, and reflective of, I think, kind of what we like to see, where our management fees are going to the operations of the entity that ultimately will help drive returns, and they're, in mind in terms of producing gross returns, so they get carried interest. It's really kind of like, from an alignment perspective, what we like to see. The firm is set up by former entrepreneurs that felt, with the right operational resources, they could help companies bend the J curve for complement some other managers in the portfolio, like Goodwater that we brought earlier in the year, that also has a consumer tech focus, but a little bit more of an international strategy. And I'll pass it on to Richard for more.
Chris, good morning to the council. M13 Ventures is a new relationship in the national program, and we're excited that it could potentially be added. The firm does focus on consumer and consumer technology companies, which is somewhat unique in venture capital. A lot of venture capital firms are focused more on the business-to-business side and the enterprise technology side, and so we do view this as adding some diversification to the venture capital portfolio that we're building for you. M13 was founded in 2016 by Carter and Courtney Ream and Carl Alomar, who Carl is here with us today, one of the managing partners. Welcome. One of the hallmarks of M13, as Chris mentioned, is the large team, especially for a fund of this size, with 45 full-time employees. They have 14 partners on their team with an average of 25 years of investment and operating experience, so quite experienced. Another hallmark is that different resources that M13 can bring to its portfolio companies. Established what's called the propulsion platform, which consists of industry executives to help portfolio companies on growth initiatives and operational issues. And this is a real difference maker for entrepreneurs who are starting out companies to have these type of resources. And the reference calls that we made to portfolio company CEOs were very positive about the impact that they were having on their company. The firm also has a Launchpad Accelerator to get an early look at companies that could potentially be an addition to this fund. From a track record perspective, the team has experience making investments in the consumer space, including some well-known consumer companies like Ring, that I know you've probably heard of. The two most recent funds under M13 are still developing, although Fund 2 has had 2 positive realizations early on in the fund's life. We're recommending an up to $50 million commitment to M13 Ventures 4, and I'll turn it over to Carl Alomar.
Thank you. Thank you all. It's a real pleasure to be here, and I appreciate the invitation. Yes, I guess a lot of the details were provided, but let me just give you a little bit of kind of the genesis of the business. I unfortunately am not a founder of the business. I joined for Fund 2, but Carter and Courtney Ream were the original founders back in 2016. Just to give an essence of what M13 is about, a lot of it stems in the name. So if any of you are astrologers, Messier 13 is the brightest cluster in the galaxy, brightest cluster of stars in the galaxy. And the concept of it is that the individual brightness of the brightness of the cluster is greater than the individual brightness of each of the stars. And that kind of speaks to the theme of how we think and how we think about our companies. We feel as though putting the right team and the right people around every opportunity that we invest in creates a much greater opportunity for a positive outcome and an acceleration of those businesses. And we practice that internally as much as we do externally. As was mentioned, we invest in 4 main categories: the future of commerce, the future of money, future of work, future of health. We think about all the technologies that really drive those categories. And so we're looking at a horizon of 5 to 10 years from an investment standpoint of where's the world going and what are we investing in that's going to drive those directions that the world goes in. We do think about investing in three major sections of time. The first is the deployment of resources. This is where we actually make our initial investments, usually in the first 2 to 2.5 years of the fund cycle. In years 3 to 5, we really focus on managing the portfolio and increasing value of the portfolio, and I'll talk to our propulsion organization shortly to give you an idea of how we think about that. And then in years 4 to 10 or 5 to 10, we really think about monetization. And a lot of firms have not really thought about monetization. We find it in their DPI, which is their return on capital to their LPs, is not necessarily reflective of how they see their firm. For us, we have a really good track record of returning capital to investors through Fund 1, looking to do the same things in Fund 2 and Fund 3. So as mentioned, our team is 45 people deep. It's very heavily driven on operations. If I give you a little bit of my background, it's a reflection of the background portfolio, of the partnership. Before joining M13, I had a 25-year background in executive leadership. I started 2 companies. I was originally an engineer, started 2 companies, one in the 90s, which we exited in 2000. Did an MBA, started another fintech company after that, which we exited in 2010. That grew to about $140 million in revenue. And then after that, I was COO of a company called DigitalOcean, which we took public, had an IPO a couple of years ago, and peaked at about a $15 billion valuation. And the reason I mention that is because it demonstrates the experience that not just myself, but all of my partners bring to the table in going through not only growth and the challenges of growth that we've had to go through to build the companies we've worked at, but more importantly, I was there during the bubble crisis in 2000. I was there during the financial crisis in 2008 and was able to navigate companies through those crises. As with my partners, we're able to provide that knowledge and support our portfolio with that knowledge. And as a result, you see our founders within our portfolio find real value in the guidance and the advice we give. Another part of our philosophy is that we really think horizontally as an investment firm. We think very collaboratively. A lot of investing firms we find, by the way, the genesis of this firm really came from a lot of the operating experience we had. My previous companies were all venture funded. I've worked with some of the best venture firms out there, and we found that there were certain things that we thought we could do better, which would really differentiate us. So we've worked very collaboratively across the team. As mentioned, we really invest our management fees back into the teams. We've built a very deep bench. And the way we work with the companies is, as opposed to everything being vertically centralized on a single investor, we do have a lead investor for every deal, but every deal is managed horizontally. So all of our investors partner with each other, all of our propulsion team partner together, and as a result, we bring the weight of the firm into every investment that we make. And that's really why we're able to have such an impact on the companies that we've worked with, and we think in time that'll be demonstrated in the returns that we're generating out of our fund. Fund 4 is obviously our next stage of investment. Our funds are $400 million. We believe that that's the right size of fund to maximize the optimal return. We think if we went larger than that, it would actually mitigate the potential return for our LPs. And so we're sticking to kind of a core fund of $400 million in size. With that being said, a couple of things I noted earlier, the interest in diversity. We have a very diverse team, but we also have a very diverse portfolio. Our portfolio is significantly ahead of benchmarks, both on diversity of gender as well as diversity of underrepresented groups. And we have the metrics to share with you on all those things to illustrate how, even though we really focus on investing on the best companies, we find that when we open our doors to a wide range of the best companies, diversity makes its way into those doors, and we welcome that. That being said, thank you, and happy to answer any questions.
Being with us here in person, so we're going to now go to questions from council. Hearing no questions, we have a motion.
Madam Chair, based on the recommendations of the Council Investment Committee, Consultant Mercer, SIC staff, and General Fiduciary Oversight of RBK, I move that the State Investment Council approve a commitment of up to $50 million to N13 Ventures 4 LP, subject and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Okay, we've got a motion by Member Tiff, a second by Member Lavender. Any discussion on the motion? Any discussion? Can we take a roll call vote on the motion, please? Up to $50 million commitment to M13 Ventures 4.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
DFA Secretary Wayne Probst.
Yes.
Nick Tejas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Harold Lavender.
Yes.
Motion passes 7-0.
Okay, very good. Thank you so much.
Thank you so much.
Thank you.
Appreciate that.
All right, next we're going to hear from New Mountain Partners, Fund 7.
We're recommending a commitment. This is a re-up of up to $100 million to New Mountain 7. It's a diversified middle market and buyout fund that invests in what they call defensive growth industries. And as a parallel to Alteris, they've also had a good track record on the healthcare side, particularly in life science supplies and biomanufacturing, healthcare technology. Committed to their prior two funds, both are performed well and are performing well. I'll take your guidance. I don't know if on the re-up side, would you like to hear the full presentation
Chair, I recommend that we have, Richard and Amy potentially talk to us a little bit about the fact that this is a re-up and that they've met the criteria that we've talked about having met to be able to be considered this way. And it seems to me that because it is a re-up in this situation, that should be, my opinion is that should be sufficient.
And managers are on for questions? Yeah, okay, perfect, let's do that.
So, as Chris mentioned, New Mountain is an existing relationship to the national program. You've invested in Funds 5 and 6. Funds 5 is a 2017 vintage year, and so far performance has been favorable in Fund 5 with a net IRR over 30% as of June 30th. We've also seen some sizable distributions earlier this year from that fund, which helped contribute to the distributions coming into the program this year, which was great to see. New Mountain has been around for multiple decades. It was founded in 1999 by Steve Klinsky, who previously had experience as a partner at another private equity firm called Fortson Whittle. He continues as CEO of New Mountain today, which has platforms in private equity, private credit, and net leasing. The firm's grown to over 220 investment professionals at this point. The private equity team is led by Matt Holt and has 23 managing directors. And in addition to the investment professionals, the firm has a number of experienced resources to help portfolio companies and also help along the strategy, everything from sourcing and screening to doing due diligence and helping with the post-investment. They also have a 43-person executive advisory council who are industry executives who can serve on boards or advise portfolio companies. The strategy of New Mountain, this fund, is focused on middle market companies. Sourcing is really driven by an annual research process where they try to find those industries that have attractive growth opportunities that are somewhat recession resistant, and then really dig into those different industries and try to find what are the good companies to target. And it might take multiple years to find good companies. Past sectors include healthcare, life science supplies, infrastructure services, consumer products, and financial services and technologies. And then post-investment, the fund strategy focuses on creating value through growing companies, or they've actually developed a toolkit as well to help companies grow. They tend to use leverage more conservatively, which is attractive given the increasing rates that we're seeing in the environment. From a track record perspective, fund performance has generally been above median, and many funds in the top quartile. And all but the most recent fund, which is still investing, have had favorable distributions. New Mountain is growing the fund size with Fund 7, but they continue to grow the resources that they have at the firm, which is a mitigating factor for this concern. We're recommending up to $100 million commitment to the fund. And we have Adam Weinstein on the phone as well, one of the senior leaders from New Mountain, to take any questions that you may have about the fund or the firm.
So, Mr. Weinstein, we're looking through some of the items provided by Mercer Due Diligence, and we've had a lot of discussions here at the SIC over the last couple of meetings about the management of Blackstone and some troubling things that we've been finding out about some of their properties on the West Coast, some of their hospitality properties. And so we see here that a percentage of the firm is owned by Blackstone. Can you just talk a little bit about that relationship and the influence of that particular entity?
Sure, and thanks very much. Hopefully you can hear me okay. Very much appreciate the partnership so far with the state of New Mexico, so thank you. So on the Blackstone relationship, so Blackstone has a fund called their GP Stakes Fund, which makes minority investments in firms like ours. And it is a passive investment. They have no governance. The capital that they actually invested in the firm, really not $1 went out to any of the partners or anybody here. It's really been used to just increase our GP commitment alongside all of us as individuals. And so that's what the capital's been used for. There's no board, there's no formal governance. They hear about transactions that New Mountain's working on when the public press release comes out, that we've acquired a company. So, they're not on the inside. They try to have some value added things that they can help us with. They've helped us on things like procurement in our portfolio companies. We can get on a bigger contract and save more money on FedEx, for example. But otherwise, it's a passive relationship.
I'm happy to hear they have no influence in governance. The more I learn about this particular manager, the more troubled I become, so I appreciate that answer. Yes, Madam Treasurer.
I'm trying to figure out how to word it, because it's on the, cons for the Mercer, discussion. And I know based on what Mr. Lofton said earlier, that negotiations can still be done on the legal side. And so, troubling for me. And I don't know how much can be stated on that. Without giving detail, please.
What page, what line?
So I'm using my investment committee meeting packet, so it would be page 14 and 15 of Mercer's, alignment. But I will say one of them is definitely, cost and the increase from last fund to this fund, and not understanding why we increased it. And I don't know if that's something legal to.
Maybe I'll address,
So we're on 280 of diligence.
I'll address one of the points. One of the things we look at when the fund size is increased is has the type of deals the fund's doing changed. In this case, it's not the case. They're not going up market. They're just doing more companies funds, which frankly, from a diversification line, they're sticking to their core knitting of companies in the middle market.
Yeah, I mean, New Mountain strategy has stayed consistent, even though they've been growing funds over subsequent funds. So we're comfortable from that perspective. On terms, I mean, we're always looking across the full gamut of the fund, from the business management, the quality of the team, to the strategy, to the track record. Terms are one component of that. We're not always going to find a fund that has every term that we like. So we look at it as a whole and make sure that it doesn't cause a misalignment with investors, meaning that the manager is more motivated to just sit on investments and collect a management fee versus generating returns for investors and generating carried interest. And we haven't seen that with New Mountain. New Mountain has really been focused on generating distributions for limited partners in the prior funds.
So I think, we see different fees go up sometimes due to just the amount of work that goes into it. So I think we walk through a lot of the terms to make sure they make sense with what is the background for it. So we do spend time with managers on that and call it out. But overall, I would agree with Richard's comment of it's a piece of the overall, and we want to make sure that, net returns, that's why we always look at net returns. It's really important because we need the after fee returns is what is getting generated within your portfolio. So we did spend time with them, but continue to ensure that net returns are a priority.
Other questions from council? Do we have a motion?
Madam Chair, based on the recommendation of the Council Investment Committee, consultant Mercer, SIC staff, and general producer oversight of RVK, I move that the State Investment Council approve a commitment of up to $100 million to New Mountain Partners 7 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
So that's really what we're talking about there, the negotiation of the final terms and things is what was mentioned before.
Try best possible terms possible for the state. Consideration, anything that council members for that, and in some ways, if we're doing the best, and Bruce helps a lot on the private equity side. Really look to have Mercer, opine that these are across the whole investment opportunity, across the fund, market, and to the extent they're not market, they'll point that out in their memo, and or,
to be clear too, I think that some of the members of the council haven't been here too long. There have been instances in the past where the legal work that the legal staff doesn't work out. And they will come back to us if they are not able to implement what we need to have them implement, and if they run into difficulties. So we've had that happen in the past, and they do a terrific job of negotiating this. I think it's really important to know that part as well.
I appreciate it. Second on the motion.
Thank you.
All right, so we have a proper motion by Member Lavender, second by Member Tejas. Any discussion on the motion before the council? Hearing no discussion, if we can take a roll call vote. This is, for the folks listening in at home, agenda item 3F. We're considering a commitment of up to $100 million into the new Mountain Partners Fund.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
CFA Secretary Wayne Probst.
Yes.
Nick Tejas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Harold Lavender.
Yes.
Motion passes 7-0.
Right, and we thank the folks from New Mountain for being on with us to answer questions and for the responses from Mercer. With that, we're going to...
Thank you very much. We appreciate it.
Yes, thank you all. Agenda item 3G, and this is a proposal to take some investment money and Mercer invested. Fairly clear, so we're going to turn it over to Mr. Cassidy to explain it to you.
I'll do my best as I can. So we're recommending a commitment of up to $150 million to a separately managed account to be set up and administered by Mercer on behalf of the SIC as the SMA's, we'd be the SMA's sole investor. The SMA will invest in co-investment and secondary transactions, which we coined principal investments. The SIC's existing managers and only our existing managers in the national program. I wanted to flag three things. We relied on fund commitments over the last 12 years, which is the length of the relationship we've had with Mercer to build the private equity portfolio. They've helped advise us on these commitments, and they've done a great job. Our performance relative to our peers has been top quartile and in some periods top decile. And frankly, we think we're just getting started. We have the best team in the world assisting us. Not something we talk about a lot, but both Amy and Richard are co-heads of U.S. Alternatives at Mercer. On the venture side, the counterpart that I speak to is the head of venture and growth directly. So they're the most senior people at the organization. And what we're talking about here is the size of our program increases over time, and it's something we've been discussing more and more. Vince mentioned today, Tom mentioned it, which is a largely result of inflows from the Permian. We feel it's important to begin incorporating co-investments and secondaries as a mechanism to invest more efficiently in private equity, which is something that, as we grow larger, our peers are doing as well. And we think extending the advisory relationship with Mercer to do this with our existing managers, which we've already due diligence and approved, is the right and best approach. So what are we trying to achieve? Two things. One is fee savings. Fee-free co-investments are a fast-growing part of the asset class. There's an increasing expectation from groups like us as we grow that managers provide co-invest in the deals that they're already doing in their funds, so we can potentially invest alongside those deals alongside the manager. If you don't participate in those deals, you ultimately pay overall higher fees as a result of that if you don't participate. Because if you only do fund commitments, you're basically paying full fees and full carry on every investment in the portfolio. And so co-investments, you're basically, let's use an example in a fund like New Mountain as an example. If they do an investment, let's say in our portfolio on an underlying basis, it's a
transactions, they'll offer the ability to, for any excess equity check that they have in the deal, let's say they write a $250 million check in a transaction, and it really requires $500 million to do the deal, they'll offer that extra $250 million to some of their LPs, like us. Generally speaking, don't charge fees and carry on that. And so when you blend all that together, it results in an aggregate fee reduction. Why, particularly as you get larger, entities look to utilize this as one mechanism to overall reduce fees. And then the second part too, and I think this is why we particularly want to start this sooner rather than later, and why we're coming to you now. We have to ramp up this portfolio over the next 5 or 10 years based on the projections we have from our strategy group, which keep on increasing every month. Anyway, but it allows you to build exposure a little faster than fund commitment. As an example, the commitments we make today will be invested over 2 to 3 years on average. Co-investments, you can put that money in the ground today. And then on the third side, and I think this is one of the more important parts, staff, and I'd like to flag that this is something staff is recommending. We've negotiated a very unique structure with Mercer that we think creates strong alignment with these goals. One, management fees are only payable on invested capital. In other words, there's no commitment fee. You're only paying fees when deals are actually done. Two, there's no carried interest. Three, termination provisions. And the termination provisions are more in line with the existing relationship we have with Mercer, which is not like any type, So basically, the net result of that is the council, you retain full control over pacing and strategy. Any additional future commitments to the SMA will be approved by the council. You retain the right to pause or cancel the SMA, basically on a very short notice. It gives the council a lot of flexibility, a lot of optionality if things were to change over time. Starting at a reasonable size, you want to build this up over time. We're also going to explore other opportunities, like, and not all managers will do this, but I think as our size increases, we can negotiate this more as side-by-side co-invest vehicles to be set up directly along the side of the fund. So it'll be a multi-pronged approach. The idea is, we're kind of starting with what we think is a reasonable structure. We're starting at a reasonable size. We're going to build it over time, and we tried to set it up in a way that gives council generally a lot of flexibility and a lot of optionality if things were to change in the future for whatever reason. And again, I want to just make clear, because in the materials, this is something staff is recommending. Mercer obviously cannot recommend themselves for obvious reasons. But I'm going to pass it along to
Could I just, and if maybe you'll address this, I'm not sure, but how will the council hear about the performance?
It'll be, we can frankly take your guidance, but I think it'll be in all the performance reports. That's what we're thinking. There'll be, we'll have a schedule of which managers that we've co-invested with, what, the performance.
And they'll be separated out?
It'll be separated out.
Yeah.
You'll have full disclosures to, we may not identify the companies, but we'll identify the managers or something along those lines. We'll disclose performance. It'll be detailed enough for you to monitor how it's going.
So let's hear from Mercer.
Yeah, so two things I really want to touch on when it comes to capabilities. We have Zachrio on the phone. He is part of Mercer has a dedicated co-investment and secondary team. You are looking at different things than a fund investment, and so it's really important that you have a team that understands how to underwrite these types of transactions. So we have a very experienced, dedicated team. That's all they do. They look at co-investments and secondaries. And to Curtis's point, we have seen increased flow of these types of opportunities coming over the past
Do you have any
year.
other clients that are doing this SMA? You do?
Yeah, we have a case study in the materials in the appendix for you to look at.
So that's really important. This will be, we will be using the team. Their expertise will be flowing through into the investments that we're looking at. Again, these will be investments that are being made alongside only the managers within your portfolio. So that's why an SMA structure works really well here. You have the opportunity to do that. And then also, as you all know, you've seen our fund investments come before you multiple times. Those go through a multitude of reviews and approvals at different levels within Mercer to even make it in front of you. And that would be no different from what happens with the co-investment secondaries opportunities. There are multiple layers of review and approval that are required before making it even to Chris and his team who retain veto power over every investment. So they've retained, control over the ultimate decision. So, so we have a dedicated team. We have a lot of processes and procedures in place to make sure that the transactions that are being looked at and are well vetted and when they are brought to you. And Zach's also on the phone from our co-investment team if you have any questions for him as well.
I would add, these will be considered in the context of the portfolio. So, as they're received, we'll look at it, is this a manager we want to do a little more with? Is it a sector that we're underweight maybe and want to increase exposure? Look at the type of deal. So all of these things ultimately, and this is where it kind of intertwines with an advisory relationship where we're going to look at everything on a portfolio context. Because, there's cases where maybe it's a big positioning in the underlying fund that we're already invested in. We don't want any more exposure, or maybe as an example, we have enough software and we don't want to increase exposure there. So that's the kind of, I think, decision that's going to be made at a high level from a portfolio construction perspective. We'll take a relatively diversified approach to this. To invest in a little less, we're not going to be doing, we tend to do a little more less risky transactions, lower leverage buyouts, securities with downside protection built into the, allows us hopefully to do things that are a little less on the risky side from a.
So I know that terms are confidential, and I'm just wondering if I can ask, these ones are not.
Madam Chair, there are some rules around SEC fundraising, and so I would not, in this case, agree with
I'm not gonna
the fees, I think, but
say anything specific. What I want to know is on your client case study, is this like a European company you do this for, or European client you do this for? Are the terms comparable that
Better for the SIC.
Better for this? Better for us?
Yes.
Market for commingled type funds. These are usually roughly a 1% management fee and 10 to 12.5% carried interest. The management fee is obviously lower than that in the materials, and we've negotiated no carried interest, which staff felt was a very important part of this.
No, that's amazing.
We're looking at this strategy as an extension of the advisory. It's a way for you to get more exposure to private equity in a more efficient way, and have some control as well. So if you decide to change your mind in a year or 3 months, I mean, it's not like these fund commitments where you're locked in. You're not locked in under this structure.
That's an important element. We wanted to retain flexibility if things were to change. If we increase staff size over the course of the next decade ourselves, and frankly, we'd probably still work with Mercer to help us with that, but maybe the arrangement changed. So we wanted it to be flexible so that in a decade, or 5 years, or 3 years, or 1 year, we can have the flexibility to change them.
Madam Chair, this can be ended. Richard, you had mentioned that to me before. Explain that if we ended up, if the council and or the staff ended up being not happy with this, what are the terms of that? How does that work? Explain that, would you?
So the term sheet is on page 337 of diligence.
This is where it's similar to the advisory agreement generally and makes it, frankly, very unique. Change things up and move on with 90 days notice. Probably, in addition to carry, this is the most unique provision. Something that I would note, this is something Bruce and I asked Mercer because we wanted to make sure there was the right alignment from day one. There's a lot of trust involved in this because they could help us build a portfolio and then 90 days notice, they stop getting basically paid. So this is a very unique arrangement. We set it up in a way, we wanted this to be an advisory relationship and not want this to be a 10-year arrangement where we had no ability to change things.
Other council questions? Yes, Member Bingaman.
Yeah, I think it's fantastic. I'm strongly supportive of the effort. Just one question around, I think last time, like before the great financial crisis, I know that the co-investments were in vogue, and I think there was like a paper or something that looked back on that and noted that there was a little bit of adverse selection in terms of the GPs were sort of offering co-investments on their most highly valued deals, and some of those didn't work out as well. Like, are you mindful of that, and like, how are you going to try to mitigate against that type of risk?
So we're already seeing it. Large entities, theory is some of them invested in some of the large cap deals done near the end of the cycle, maybe growth equity deals. They, if you look on page 5, our focus is really going to be for the middle market. Core buyout, and the managers we brought today, I think, are great candidates for something like that. These low leverage, the price values of $1 billion, we're not going to be investing in this. Because I think you're dead right. Like, I'm old enough to remember this. So at that 2008 period when you had these huge club deals, like with 4 sponsors, and they're doing massive co-invest, I think that was some of the California or some of the other that got into that. We're definitely not going to go down that road.
But I think it's where underwriting and having that, using our dedicated co-investment secondary team, because they're seeing they'll always, look at each deal that comes through. So they're very aware of those, and that's where, them spending the time and their expertise looking at things is really important.
So conversely, on the other end of the spectrum, we've seen folks invest in kind of some late. That's not going to be the focus of this. If anything, hopefully we can, in that lane, and the start there is where we're going to want profitable companies, low leverage, no mega buyout, no venture.
Okay, that's reassuring for sure. Thank you.
Did you want to hear from the co-invest guy on that, or no?
No, I think that's sufficient for my purposes. Yep. Thanks.
Yep, okay, Madam Treasurer.
I appreciated yesterday, I got to meet with Charles and Mr. Cassidy, to go over some of the questions that I had, and I did get a lot more at ease, because when I looked at the SMA summary terms, I was trying to decipher, put them all on a spreadsheet and decipher the fees there versus the regular fees we have, and they're pretty much the same. And so I was like, well, where are we saving the money? So the clarification was that it's on the commitment fees and also on the carried interest that we usually do. How long is the current consultant contract with Mercer, and how is that impacted by this new relationship?
So we set it up so that they're separate arrangements. The term of, or 4 years, we just did that earlier in the year. The advisory agreement is 4 years, and that's similar, correct me if I'm wrong, Evan, similar termination provisions to this. We wanted to set this up in a way where if we ever needed to change things, we could retain them in the advisory arrangement on fund commitments, and this is separate. So we wanted that flexibility because we want to retain them on the fund commitment, whatever we decide to do longer term. And this is, we didn't actually, did we actually come up with a term here? we expect, 2 to 4 years to the commitment roughly, and that effectively puts a time limit on it. And if we were ever to ask for any more, we would come back.
I would say if I was Mercer and they got rid of me for 30, 60 days on one end, I might not be too happy on the other end. But to your point, you mentioned that you do already do this. What states or with what entities do you do this specific type of investment strategy?
On a discretionary basis, so it's confidential, but we do it with other entities that they require us to discretionarily invest in co-investment. We don't do it with any other public entity.
That's exactly my point, yes. To be the first public entity that you utilize this type of strategy. Can you talk a little bit about the concern of any conflict of interest or how the Chinese wall comes up? And that comment comes up with the idea of questioning, well, why don't we do it in-house since Mercer's going to give us information so that Mercer's not having both ends of it. It was the capacity. We don't have the capacity at this time to do it internally, and there's a lot of complexity in that. And I agree with that because we invest in-house and, cooperation. But can you go into sort of the way that the Chinese wall gets set up or any types of conflict or internal controls?
Yeah, so different committees internally at Mercer are going to be required to approve. So again, on the fund side, we have different committees that goes through before it comes here. On the co-investment side, our co-investment senior leadership are the ones that are reviewing and approving things to move forward. It's a unique situation because you are co-investing with the funds that you've already been approving. There's a lot of collaboration in the fund side and the co-investment side, but when it comes to the actual reviews and approvals, that is done by separate committees that have specific senior expertise in each of those areas.
So on my end, I mentioned that I have a lot of concern about this at this point because we don't have an executive director, or we're hiring an executive director. We have two co-executive directors, and this is a completely different strategy than what we've done in the past. And so I have concern that if I'm always trying to put myself in the shoes of the other person, right? I get on the private equity side, we need to invest, we have the money, and we need to do something different, and we're trying to save money. On the other end, if I'm the person running or, applying for executive director, I've already tied my hands to something new without me being involved in that process or the buy-in or sharing my concerns with the council. And so, I appreciate that the thoughtfulness that's in there to look at how do we manage the amount of money we're bringing in and minimize fees because it is, astronomical. So I appreciate the thoughtfulness on that. I just feel like the timing is a little bit off. I know that it will take at least 3 months to put this together, but I feel like I would be overstepping someone else's toes and them not being able to come into their administration and be able to have thoughtful conversations and discussions about this and give us their intake as well, because it is a very different philosophy. And if we are going to be the precedent of all other government funds, then we should at least do it with our executive director intact, because whatever we do, others will follow. And that also needs to be taken a look at. I will say, I don't know what the consultant fee is, so I wouldn't even say it out loud publicly. But adding in the additional basis points is high. I think there is risk in the relationship because you can let go of them pretty quickly if something doesn't work out. And I think that Chinese wall needs to be a little bit more thorough. One of my suggestions that I made yesterday was putting the spreadsheet together and being able to see $150 million, what does it look like on our normal strategy, and what does it look like without it? And, he gave a really good, description of like just the 20%, which is, how I figured it was the carried interest. So, that's where my take is on it. So let's just,
Make a comment if it's okay.
yeah, we'll start there.
There's a lot of entities that are, we're given the inflows, we're talking a big step, on page 320, it's kind of a step change in the size of this portfolio. As it gets larger, these types of co-investments have just become the norm. And frankly, a lot of institutions, including the one I mentioned in the footnote, they actually break out their fund commitments and investments, to make sure there's an accounting for, the difference in performance. Hopefully these will stay absent of fees, should produce good returns. And the other thing too is the entities like to talk about cost savings too. They generally try to keep a running tab the best they can as well. So there's precedents for other entities as to how they would kind of report this.
Reporting of cost savings?
And look, I mean, that's a separate administrative item that we have to come up and figure out the best way to do, because it's a little bit of a hypothetical, but other entities that work out. So it's an increasing thing in the industry. Over time, it becomes important to make thoughtful about fees.
I don't know if there's general appetite from the council for postponing till after we have an SIO, but I guess I'm wondering from Evan, this is half cutting for us. We'll be the first public fund to do this, with Mercer, sorry, I did not mean that was not a general statement. We do not have, an SIO hired, so, what is our ability to have that conversation with that person when they are official?
Two questions there that you've asked as far as Madam Chair. The first is can and should, I think. The answer to can is yes. It is legally permissible to do this. The should is the discussion that you're having at the council level. And so the questions, the factors are, I would think, the idea of giving the successor some input. I would just think, and this is the first I've been asked that, would be that there is a 90-day out, and most likely based on what I've heard on the Ms. Allen's report, it's going to take 3 months to set up. So at the end of the day, the new person would probably have to sign the contract to make it happen, but it would be started, admittedly, without that person. And, it's just a question of, I don't know the answer if it would hurt us or not. I don't think, given the numbers, that it would hurt us to wait. And yet, at some level, if there are very good reasons to do it, as a fiduciary, you could do it as tell. The question is straight comfort level as fiduciaries and overseers, what this group is comfortable with. And so I don't think there's a right or wrong answer. It's just simply a question of, the board's appetite for a strategy. I think what's a little confusing as I hear it, it's not confusing, but we have a consultant relationship, and that is a consultant relationship, an advisor relationship. This is a manager relationship, and I think without putting words into Chris's mouth, why he likes it is because Mercer has the ability, these are existing managers.
And we have an established relationship.
So there's an advantage there. But the manager side, which is more of what's up on the screen than these folks, they are subject to SEC rules, and so there's no opaqueness in terms of this discussion. Not on the consultant side, not on that stuff, but on this. So I don't think it's a legal problem, but I understand that there's a policy, which is what you do, issue in terms of if you want to be out in front, or when you want to do it, or how you want to do it with people, and I'm not sure, that was somewhat vague and deferential, but I don't think there's a right or wrong answer to that. I think it's what you like.
Madam Chair, if I could, on that point, I think time is of the essence, and I think that we have to deploy capital. I mean, I think we have a real important responsibility to get that capital deployed. I think we have tons of cash, and we need to meet the metrics of our investment policies and things of that nature. We're on the precipice of having to really quickly start dealing with $100 billion portfolio and fund, and I think we have two people in private equity managing that. Am I right?
We're up to two.
We're up to two. And I know they're really good. They're top notch. But I mean, we've moved from when I started on the council from about 24 billion. Now, in the next few years, potentially 100 billion. We got to give capacity and the team help, and I think this is a really innovative way to do it. And I think it saves the taxpayer money, with avoiding that carried interest. We do need to definitely be apprised on the real structure that's in place with that firewall, the internal control between management and advice. And so please be sure to keep us apprised of that. But that's really my only issue at this point. So
I appreciate those words. Anyone else? May I ask one other question? I don't know if this goes to you or to Mercer, but as far as like SEC and the fiduciary role on both sides as a consultant and as a manager, do you have the same role and responsibility, or are they different? I'm thinking it might be you're a fiduciary on the consultant side, but on the manager side, you're not.
No, it's the higher standard because we have discretion. The higher fiduciary standard.
As a manager for it.
Yeah.
And then as the consultant,
We have fiduciary.
the fiduciary role. Okay. All right, so if we have no further discussion on this item, I'm going to go ahead and take a motion.
Madam Chair, based on the recommendation of the Council Investment Committee, Consultant Mercer, SIC staff in general, fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of up to $150 million to National Private Equity Program, Principal Investments Program, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
All right, so we have a proper motion from Member Lavender, we have a second from Member Tejas. This is on a, up to $150 million,
Yeah, it's in there.
and we're on agenda item 3G. Any discussion on the motion?
Just so you know, Madam Chair, this was unanimously recommended by the Investment Committee after we had the lengthy discussion.
I appreciate hearing that because we don't have a member of our investment committee on with us today.
To make sure the motion didn't recommend Mercer, because, they can't recommend themselves, so.
The motion does recommend.
It says, consult Mercer, that's the second word.
Yeah, they can't recommend themselves.
Can you restate the motion, please?
And what do I need to change?
Strike Consultant Mercer.
I'm sorry?
Strike Mercer. So take Mercer out.
Oh, okay. Based on the recommendations of Council Investment Committee, I got you, now I understand. SIC staff and general fiduciary oversight of RBK, I move the State Investment Council approve a commitment of up to $150 million to National Private Equity Program, Principal Investments Program, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
I'll second that.
Okay.
Thank you.
We have a previous motion stricken, I guess?
Correct.
We didn't,
Yeah.
we never voted on it.
We never made a motion,
Yeah.
it's just a
Okay, so we have a.
That's right, you're right, you're absolutely correct, thank you.
And a second. Discussion?
We're gonna take a roll call vote. We still do have a quorum. We did lose the secretary
You have 6, you need 4 yeses to pass the motion.
temporarily, and so we do still have a quorum.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
No, and explain my vote.
Nick Tass.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Harold Lavender.
Yes.
Motion passes 5-1.
Yes, we're gonna go to Madam President. I appreciate Mr. Cassidy, your time yesterday and your thoughtfulness. I didn't realize there was only 2 of you in President Equity. I even have a high regard for you. My vote is not off of anything with your guys' expertise. I think you guys are great at what you all do and your team collaboration. It's more about waiting for the, sector, and I appreciate the thoughtfulness to figure out how we can save on fees. So thank you very much.
Thank you.
And I'll explain my vote too. I feel a little bit guilty for giving you the problem of too much cash. Probably hard to. With that, let's move on now to, agenda item 4. We're gonna hear from our Chief Financial Officer, Mr. Schiff.
Madam Chair, I will be quite brief with my comments. I'm on page 363, and I think this is going to be the only page that I touch upon unless there's questions. As I've done in the past, I've provided a budget schedule in the investment holdings report. I did want to point out on the budget schedule that the bar that we requested earlier in the year is now reflected. It was a little over $900,000. It's for the funding of the additional positions that were not funded by the legislature, as well as provides funds for the satellite office that will be opening, as well as furnishings for that office.
So what's the increase?
It's about $900,000. And that's a good question. It's allocated between the 200s, which is the payroll category, and the 400, which is the other category. If it was just the 300s, we have plenty of dollars within the 300 transfer from the 300s into these other 2 categories. The problem with that is the transfer is kind of temporary, bar is more permanent, so we were instructed or guided by some input that we got that the bar was the way to go on that. And then item number 4, I did want to point out that the exit conference with Moss Adams has not been scheduled yet. We're continuing to work on our audited financial statements. I think we're pretty close to having a draft to Moss Adams. If there's anybody that is interested in participating in that exit conference, I'm sure Nick would welcome that.
I always tell people that I'm a commission of one. You are a committee of one.
Yeah, he does have Mike Everett, an advisory member, helping him, and it really worked out. No other council members. So if anybody wants to be involved, it gives you an opportunity to speak with the auditors, and if you want to talk to them offline, I'm sure they can do that as well. And then I did want to point out with the investment holdings report, since it is for the period ending September 30th, that it's a quarterly report. You'll note within that report, we have roll forwards done on a monthly basis and a quarterly basis. So just realize if you're rolling something forward or looking at a schedule that's the prior month, the starting point is going to be different than a prior quarter. So just be aware of that. And then lastly, I think Charlie mentioned this earlier. He and I had a very nice meeting with General Grizzle of New Mexico Military Institute on October 19th. And I have to tell you, I was kind of not really looking forward to the call all that much. The General was recommending some changes to the way we report some things based upon his understanding. And we got into the Zoom call, and Charlie and I led him through some of our calculations, and we saw the light go on for him. He was very happy about the situation, but one thing that I think both Charlie and I recognized is there's some additional reporting that we can provide to our clients that will allow them to better monitor what the distributions are on an ongoing basis. So we're hoping to make improvements with that. And then I also wanted to thank Madam Chair's office. We did meet with the Mexico School for the Deaf on October the 11th with some of the exact same questions. And I thought that meeting went very, very well, and we're going to continue to make improvements. And that's all I had on my report on my first question.
Let me just use this moment to thank you all for, really being intentional in our beneficiary relations. I mean, obviously, they're sort of,
Absolutely.
And with the change in the distribution, I think folks have a lot of questions. They're confused when they see trends that don't look like they make sense to them. So the fact that you all are willing to provide materials, be transparent, answer questions, be accessible is, I think that goes a long way for these folks. I mean, with the 40 plus billion that we manage, it would seem like, oh, my $12 million budget, is not really a big deal for us, but that is like some of their operating.
Big deal.
Yeah, it's a big deal. And it's a particular service that we're proud to support. I think SIC is proud to support, so I very much appreciate you all being able to fit that into your schedules, making time to do that.
Madam Treasurer, thank you for facilitating that meeting, and I do think that we identified some important things with those two meetings with the beneficiaries about how we can improve our reporting and make their lives easier around the monthly distribution.
Oh, that's amazing. That's great to hear. Thank you so much.
I would point out, go ahead.
I just want to follow your comments up. These investments for the clients that are higher ed institutions are really, really benefiting greatly because they, most of these institutions are placing money with the SIC, and those dollars go back to scholarships. So their foundations will place money with us, and then the return on those investments will actually pay scholarships. So when we have a greater opportunity for return, as opposed to trying to do that stuff on our own, the SIC have a lot of other managers that you might just find out on the street, so you can offer up more scholarships. So directly related to students and education.
Madam Chair, I just wanted to add to what you said about the two of them doing what they did, and the team. I just think it's important that we continue to recognize the incredible job Brent and his team have done. Every report I see, there's no exceptions. I mean, one after the other, and that's a big deal in the accounting world. I mean, I've been in institutions where the exceptions significantly outdid the non-exceptions, and I just think that it's really important to recognize that. So I just go on record of saying how much I appreciate the job they've done, and that's for a fellow Hornet.
Just, Madam Chair, a quick question. Do we manage any nonprofits, like, community foundations or any nonprofits? Is it only state institutions and educational institutions?
So, Ms. Allen, we have a lot of abilities to invest for state agencies, state entities, political subdivisions across the state, but nonprofits are not among those. We do invest, as Member Tejas referred to, foundation money for certain state universities and community colleges because the benefit goes directly to the students, and so it's allowable under the statute. We have grown our client base, and I don't want to muddy. We're kind of talking about clients and beneficiaries. There is some crossover there. We do have a couple of those that are in both buckets.
Yeah.
Yes, and so we do like hearing from them. We like the communications that we have. Frankly, we wish we had a little more, and I think that's one of the reasons why we're getting Don involved with the process on the client side. We would have to have a statutory change if we we were to do things for nonprofits.
Ah, interesting.
All right. So you could, like if the Museum Foundation came to you, you could not do them without a statutory change. The New Mexico Museum Foundation. You could not.
I don't believe,
We're gonna hear from the GC now.
It would depend on the structure of whatever potential client you're speaking of. If the potential client is affiliated with the state in some way, they likely would fit under our statute, with the exception of anything below a Class A county that we discussed. Below is the wrong word, anybody who's not of the size and economic background of a Class A county. So I think what you need to think about is the tie to the state. If there's a tie to the state within the organization that you're thinking of, there's a pretty good chance we could take them on as a client.
Okay, I'll talk to you separately on that, but thanks.
I will say also, for those council members that aren't aware, SIC also is asked for retiree healthcare and for MFA, New Mexico housing. And so, those are two of the other boards I'm on, and very well appreciated. I think, Don will start talking to them more. I think that would be good. I do know that they weren't aware that Steve Elise was retiring, and so I think we gotta make sure and touch base with, all of our clients and posted. So I really appreciate you formalizing your spreadsheet to accommodate their needs each. Do you have something else you wanted to add?
I think Charlie touched upon it.
Okay.
Thank you for asking.
Any other, further questions for our CFO? Hearing none, we're gonna go now to old or new business, closing matters, agenda item 5A.
So, Madam Chair, in your materials,
Got a hand up here.
Yeah, I've got a question.
Member Allen, let's hear from, Charlie, and then I'm gonna go right to you.
Okay, thank you.
so in your materials, you do have a letter, that, at the request of the chair last month, looked into, some allegations that were made during public comment. We did get a response from the manager involved, Blackstone, and that letter, in your materials is from them addressing, the bulk of those, if not all of them. And so that is for your review and consideration.
Member Allen. Member Allen.
So the union that were at the meeting at the last meeting have called me and said that you said for them to talk to me, I guess as chair of the governance committee. And I wanted to understand what your expectation was for me to talk to them, and how is that a purview under the governance committee? This is about the issue about BlackRock and the casinos.
Yeah, so it's Blackstone, and, it was just a suggestion, for council members to be able to hear out the grievances of these folks. It wasn't just you, because you're on the governance committee.
Okay, so it's just a council member to hear. I'm happy to talk to them. It's just listening is basically what you're saying. No action. Okay.
That's exactly right.
All right, thank you.
To, use this time in my prerogative as chair, to take the floor, and remind us that we did pass our first ever ESG policy in 2021, which has the following statement. In managing investments consistent with our fiduciary responsibilities, our ESG policy states that SIC will, quote, consider ESG factors which can present material business risks, end quote. This encompasses a wide variety of factors, including, and this is in our ESG policy, social criteria, such as how a fund or its investments manages relationships with their employees. So we heard, and I believe we will hear again today, about some troubling relationships and labor strife continuing between Blackstone-owned properties and Blackstone themselves. We are invested in, I believe, 3 Blackstone funds currently. And so because these particular investments
pose both a business risk, but I would submit a reputational risk for this public fund. I would caution the council to seriously reconsider further investments in Blackstone. That's my statement for today. Let's remember the fact that this body passed an ESG policy that specifically refers to relationships between our fund managers and their lawyers, their investments, their property investment statements. And if folks would like me to recite where we talk about that in our ESG policy, I'm very happy to do that. Okay. I would say, just as a comment, becoming more of an issue nationally, and that puts our own funds at risk. And from a financial standpoint, that also concerns me, because I'm hearing it all over the place, and a lot more people are starting to support the cause because of the fact of certain things that are, I think, adding fuel to the fire. And so I will give you an example. In my office, it's not, to me, an ESG issue, it's just a follow the law issue, where there was a story about 9 different entities that were using child labor. And I have 3 of them that we were investing in, and I put them on my caution list. I said, we're not investing with you anymore until we get more information. We can hold you to a higher standard and make sure that you're addressing these concerns, and how are you addressing them. 2 of the 3 are now no longer on our caution list. They were able to bring back deliverables to show us that they are following federal and state laws, and that they're doing what they can to make sure and prevent child labor from occurring from secondary factories. On this issue, I mean, there's, of course, the humanistic issue, and I know most finance people don't really care about that, or put that to the side and look at it more from the financial issue. So I'll say on the financial issue, it's high risk. There's a lot more people who are motivated to not go to their hotels, who are frustrated about putting Black people against brown people, frustrated that the boss makes over $1 billion a year, but people aren't even able to afford a 1-bedroom apartment in Los Angeles. And at the end of the day, we have to look at the bottom line, and all of those risk factors are in place with that. Those are my comments, Madam Chair.
I appreciate that, Madam Treasurer. I forgot to mention that you had actually taken investment.
But let me just give one final example, and that is, and this is cited, so I can provide the citations on anything that I'm talking about today. PARA, so our former executive director of PARA, who is now our current DFA secretary, had to step out, so perhaps we can ask him about this offline. PARA had stopped investing with the firm Blackstone in 2012. They have had no further investments in Blackstone since 2012. And they are faced ESG risk from exposure to Blackstone's hotel labor dispute. Page out of someone from here in New Mexico, our public employee retirement authority. All right.
Madam Chair.
Yes,
I just want to support your comments and support the Treasurer's comments. I think in terms of the bottom line, these things matter, and corporate responsibility, it touches the outcomes on investments, especially those investments that are long-term in nature. We're allocating, public equity contributions 5 to 7 years. And if institutions and corporations are not planning for those changes that are happening now, and they're not planning for 10 years down the road, that does put our investments at risk, I believe. So we have to stay on top of that, and we need to make sure that I would just like to see us kind of charge up the efforts on ESG as we look at these investments to make sure that we're ahead of any potential negative outcome with our funds and the benefits that
And well said. All right, so, we're gonna go to agenda item 5B, which is the announcement of our next meeting. We have a meeting in November on Tuesday, the 28th, I believe, here in Santa Fe. With that, we'll go to public comment, and that's agenda item 6. We'll ask if anyone has signed up to give public comment. Or just that.
Well, I'm gonna have to go take a look at the list. I know we have some people waiting in the hall, so. Behind you.
While we're waiting, just something I wanted to bring up that I brought up yesterday to Mr. Charles, is two things. One is fees. I know that Alex gets an idea of what fees we charge, or what fees we're charged. But I would like the council to consider getting, Fund 1, 2, 3, 4, not putting their names on there, and being able to see what that looks like and then how much it is, especially when we're doing a deal with someone that we've already done it with. Did we meet those expectations? Did we surpass those expectations? That would be very helpful for us as a council. The second thing I thought would be helpful is, all right, so we have 3 members signed up to give public comment: Brendan Walsh, Fernando Perez, and Matt Pina. Okay, if you all would please make your way to this end of the table. So our deal is, introduce yourselves, say who you are, where you're representing. You're gonna be allotted 5 minutes to give your public comment. We do not do, an exchange with folks who give public comments. There's always opportunity to, chat with us afterwards and things, but in the meeting, we don't do a back and forth.
So, yes, I'll start. Good morning, everybody, council members. My name is Brendan Walsh. I am the co-political director of Unite Here Local 11. I also serve as the executive director of Worker Power. It's a 501c4 nonprofit organization dedicated to preserving democracy and improving the lives of working families across the United States through voter engagement and strategic policy intervention. So we're here to follow up on some commentary that we made last month, and I think that several members have already spoken about it, and I appreciate your comments very much. But we wanted to follow up regarding New Mexico SIC's investment in Blackstone Group. We appreciate the time that many commissioners took to meet with Local 11 representatives to discuss the labor disputes at the Sheraton Phoenix, Fairfield, LAX El Segundo, and Aloft LAX El Segundo over the past month. We saw Blackstone's response, to which Mr. Woolman referred to the strikes at the Aloft and Fairfield, and noted with concern that the firm offered no concrete actions that it's taken or could take to resolve the disputes, and ignored the issues regarding the Sheraton Phoenix. Many Sheraton Phoenix workers, as you'll hear, make as little as $17 per hour and have little access to affordable health care or a pension. According to the Massachusetts Institute of Technology Living Wage Calculator, the living wage for a family with 2 adults working and 2 children in Maricopa County, where Phoenix is $24.12. Blackstone's Fairfield and Aloft LAX El Segundo hotels. At those hotels, most Local 11 members make $20 per hour. Again, according to the MIT Living Wage Calculator, the living wage for a family with 2 adults working with 2 children in Los Angeles County is $30.15. Blackstone's CEO made $1.27 billion last year. A worker at the Fairfield making $20 per hour would have to work 30,000 years to make that same amount. This type of income inequality is simply not sustainable, and that is why the workers have gone on strike. 3 hotels have settled tentative agreements with Local 11 following months of rolling strikes across Southern California. Blackstone must take responsibility for these risks and follow the example of the hotels that have settled the disputes. We ask that SIC inform Blackstone it will be halting investments with the firm until it resolves the disputes and guarantees labor peace in future hospitality investments. This is in keeping with SIC's ESG policy, which seeks to invest in entities that strive for long-term sustainability in their operations.
Good afternoon. My name is Matthew Pena, and I have worked as a cook at the Sheraton Phoenix downtown. I'm a proud member of Unite Here Local 11, and I'm a proud transgender man, but trans-affirming healthcare and birth control are expensive. So expensive that I was forced to sell my plasma to pay for my healthcare, but I can't do that anymore because I'm diabetic. It is a constant struggle to afford my basic needs, keeping a roof over my head, paying for healthcare, putting food on the table. Rent in Phoenix is skyrocketing. My rent has gone up hundreds of dollars over the last few years. It's forced me to move back with my parents. I can no longer afford the rent for my apartment on the hotel's wages, even with a roommate. It shouldn't be this difficult. That is why I'm fighting for living wages, affordable health insurance, and a pension, so one day I can hope to retire. Blackstone is the largest investment company in the world with $1 trillion. They can afford to pay us fairly. The question is, why are they choosing not to? For the past several months, even when the temperature is almost 100 degrees in the morning, my cooks and coworkers and I have held picket lines outside of our hotel informing guests and the public about the labor disputes. Labor disputes are not good for business. Most recently, I believe that I have been unjustly discriminated against for my protected union activity as a union committee member. We have filed an unfair labor practice charge against the Sheraton Phoenix with the National Labor Relations Board, alleging that I was unjustly suspended and fired. I am only standing up for wages, benefits, and the working conditions that I deserve. I don't deserve to be treated unfairly. Please tell Blackstone to resolve the labor dispute.
And, we know that you were not able to stick around you came all this way last month, and you were not able to give your public comments, so I'm so happy that you were able to do that today. Thank you so much for this.
Thank you.
But I was lucky enough, and I was here, and I'm Fernando, and I'm so happy to be here in your beautiful city. I just admire. There was not my second time to be here. It's beautiful. Not for the same reasons, but I'm happy to be here. So, I'm Fernando Perez, and I've been a housekeeping supervisor at the Fairfield and A-Love Hotels in the Segundo for more than 3 years now. I've been working in the housekeeping department, and for my position, I have access to information as a part of the management, and also I have my interactions with the room attendants and the rest of the staff. Some things I cannot share because just know better than me. Well, I recruit today to urge you to tell your investment manager Blackstone to restore the labor dispute against thousands of other hotels workers across Southern California and Arizona. Since we spoke last month, I said the hotels have offered insulting bargaining proposals. The hotels propose to cut our health, the health contributions through July the 4th, 2025. The recent survey of employers project an average health cost increase of 5.4 in 2023. It's higher pay and better benefits, no stress to our health insurance. So we strike the hotels again. When I said again, we did it recently last week, and it's our third time going on a strike for 4 days on the road. Thursday, Friday, Saturday. So it's the third time that we do that. Also, he mentioned we are making $20 an hour, and that just happened recently because of the act we begged for emergency rate of $2. Salary for the last year was only $18. I mentioned that because Marriott, Hilton, and ANG, the one who owns Intercontinental, the biggest building in downtown Los Angeles, they put it decent, and you can see those companies, right now, they pay $25.50 an hour for the room attendant. I was supervisor in downtown Sheraton, downtown, that way, We as supervisors make over there 26 and 50 cents. Oh, it's always $1 more than them. So, at downtown, they make $25.50 room attendant versus $20 in Blackstone. If you put that one in perspective, it's a huge world of difference. $5 an hour is a lot. So, and that is happening right now. As everybody knows, even here in the whole country, the cost of living is too high in Los Angeles because landlords keep raising the rent. Another note I can share with you is to make it worse for us is, again, Los Angeles City, just a city, it's not a county. Los Angeles City had a rent control. They cannot increase the apartment rent whatever they want. But as soon as you cross the street, it's a Beverly Hills, Westwood, whatever city you want to cancel, or El Segundo, just crossing the street, they do whatever they want. That is the reason they can raise the prices of the rent rate. In December 2022, a Blackstone executive said that the firm estimates it can increase rent 20% higher than it is currently charging. The same company that pays us unfair wages is bragging about how much it can jack up our rent. We need action from Blackstone, not excuses. The Fairfield and Nayla aren't the biggest hotel that workers have struck, but Blackstone is the biggest private equity firm in the world. They can fix this problem if they want to. They tell Blackstone that SIC will not give the firm any more money until they resolve the dispute.
We appreciate you all being here. Thank you. Members may have a comment. Madam Chair, if the council could get a list, and I don't know if this makes sense, but a list of the bills that don't come before us. I got an email the other day that the Housing Investment Trust had reached out to SIC and stated that it was not something that we're interested in right now. So for things like that, I don't know if there's several of them throughout the month that we say, well, it doesn't fit, our portfolio or asset allocation. We consider an investment and decide not to go with it. What happens to those? Where is that? Is that record kept?
Okay, so you're talking about managers who approach the SIC looking for investment. Typically, what we will do, correct me if I'm wrong, we will take meetings if there is potential for opportunities there, but we will have an assessment initially. Do we have an existing relationship with the manager? There are other factors we take into account. Is it a good fit? Is this manager in enough capacity? Example, the Alteris first met with SIC in 2008, 2009. I mean, that investment, Chris wasn't around, but I was around, and I took that meeting with, not the gentleman who was here, but his partner. And so, there is a process that we want to be responsive, but a lot of times, you're not the proper avenue for firms that are seeking investment.
And so I think what she's asking for is it possible to see who were those firms?
Whoever you're denying, can we get a list of who those are that are denied? Because, for example, the Housing Investment Trust is something that I would like to come before the council, for the council to make a decision if, and FIC can decide and say, no, this is why, but I want them to have a fair shot of being able to invest in New Mexico because housing is such a big issue. We just had a roundtable on this. I'm on other boards that deal with direct housing issues, and I thought this would be a perfect opportunity. I mean, maybe now that Mercer's on the private equity side on that other end, maybe they could do an analysis of the Housing Investment Trust. But that made me realize, well, what happens to all those bills that don't come before us? Because we never see them and we never know that they exist. We're only getting the ones that SIC thinks we should see in the direction we should go, which then makes me feel like I'm more of a rubber stamp. I'm not making real decisions on all of the things that come before us, and I don't want all of them, that's why we have staff. But I'm just curious, what can we do, what's the proper avenue to not put more work on SIC, but for us to be able as a council to see, and it's like a consent agenda, if we don't like you know, if we want one of them to come before us to hear it out, even if we don't agree for them to be here, we at least have that opportunity.
Yeah, Madam Chair, I was just wondering, I thought with Housing Investment Trust, maybe the treasurer was referring to like a potential client of the SIC, like they would invest money with us, or this was a fund that was being raised? Okay.
And to be honest, I'm sorry, I'm not familiar with that fund or where in the portfolio that might fit. A lot of times, the herd gets called at the consultant level. There are some basic criteria that we have, as far as.
So I don't think we should get into specifics. I think what she's asking for is it possible to see who has been denied?
That would.
Is it a lot?
It's a lot, yes. It would be a huge amount. I mean, so I have a forward-facing email. I get about 80 emails a day. Now, I'm not saying all of those are a lot of those are, you know, marketing or, but I do get inquiries about the New Mexico program especially and the Emerging Manager program. We defer to Mercer on a lot of those for the first set of due diligence. With other things like, the housing trust, I'd be interested in hearing more about it. So please, if you have things like that, highlight it to me, highlight it to Vince, and we'll definitely take a look and come up with a real answer. We don't like sending people away, but sometimes that's the hard truth, that it's not an appropriate avenue, and it's just not a fit. Could be at a later time, like Alteris. Took 10 years, but we made that investment, and they were too small initially when they came to us. They were raising a $300 million fund. Now it's 10 times that. So never say never, and want to have a good relationship with members of the public and stakeholders. Certainly the council is a huge part of that.
All right. So with that, we're going to move to agenda item 7, which is adjournment.
So moved.
All right, we've got a motion by Member Lassiter. We don't need a second. We don't need to vote.